All right, so is financial reporting one of the one of the easiest papers in the IC level 2 level. To me, easy is relevant. Easy, the easy that I'm talking about over here is relative. So maybe I don't know how it is for you, but for me, it's something that you can easily pass and move on. Okay, so we first of all look at the exam structure, and the exam structure is you are going to be having 5 questions. Each question is 20 marks. Okay, so you are going to be having 5 questions. Each of them will be carrying 20 marks. So the question one will always be the consolidation that will be for 20 marks. But the consolidation itself is 25 marks. So you always see a theory question on consolidation in question 5. So question 5, there will be a portion of what? A question on consolidation that will take 5 marks. So consolidation in all is 25 marks. Okay, then you come to the reporting standards. The reporting standards is just the financial reporting standard, the ISs and then the FRSs. It's also 25 marks. So you see 20 marks question at question 2 for the reporting standards and 1 question in question 5, which will carry 5 marks or 4 marks. It depends on how they want to share it. Okay. The ethical framework and conceptual framework is 10 marks. So you see questions on ethics or you see questions on conceptual framework. You see questions like maybe they can examine you on the measurement criteria, they can examine you on recognition criteria, they can examine you on the qualitative attributes of financial statement, they can examine you on any other thing that will fall under the conceptual framework. So they will also come to the question 3, that will be the published account. So which we call the final account. The final account, it can be maybe your normal account, which is profit or loss or statement of financial position, or it can be a cash flow statement. So it depends on the examiner. They can choose to bring a statement of cash flow. They can also choose to bring what? The final account, which will be your statement of profit or loss and other comprehensive income, your statement of changes in equity, and your statement of financial position. The last side, which is the question 4, will be the interpretation of financial statements. So interpretation of financial statement, we use so many tools to what? To interpret the financial statement to the users of that particular statement. So we use ratio analysis, we use common size analysis, and maybe they can also ask you to use other tools, or but basically you'll be using the ratio analysis and then the common size. For now, they normally examine the ratio analysis. They will ask you to calculate some ratios and also use the ratios to what? To read meanings to what? To the financial statement, which we call the interpretation. So if you have calculated your gross profit to be 25%, what is the meaning of that 25% to the users in terms of performance? What is the 25% showing? That's what they are asking you to interpret the 25%. What does it signify? That is the interpretation that we are talking about. So today we will try to look at consolidation and the interpretation of financial statements. Tomorrow we will look at the reporting standards and then the published accounts, because they work hand in hand. The published account, the footnote is full of standards. It's full of standards. So we deal with consolidation today and the interpretation of financial statements. Then tomorrow we deal with the published accounts and also the reporting standards. So before we pick a question, I want to give you some tips on how you can answer questions on consolidation. Okay, the consolidation, they will ask you to prepare either statement of profit or loss or statement of financial position or both. So they can ask you to prepare statement of profit or loss, which will be the consolidated statement of profit or loss. So we have the consolidated statement of profit or loss. So they can ask you to prepare the consolidated statement of profit or loss. What are the things that you have to do? If you are preparing consolidated statement of financial position or consolidated statement, the meaning is that you are putting 2 or more entities together. So you are going to be adding, we have one company called a parent company, and you also have another company called a subsidiary. So if you are preparing consolidation or you are preparing consolidated financial statement, it is as if you are adding the two entities together as if they are single economic entity. So the financial statement or the items will be put together. So if you take the revenue, you take the revenue of the parents. So you take the revenue of the parents. Then the revenue of the parent, let's say, is 200. Then you add the subsidiaries own to it. The subsidiaries own the portion of the profit that the parent is going to be taking is the portion of the revenue that you are going to be adding. What do I mean by that? The reporting date is December for the two companies. The reporting date is December. But the parent acquired a subsidiary on July 1, 2021. Okay, you can see that the subsidiary started trading before the parent acquired them. So for the first 6 months, the parents were not there, so they cannot have a share of the profits for that particular period. Okay, but from July to December now, the 6 months, the parent is now part of the owners of the subsidiary. So any profit that will be made during that particular period will be shared among the owners, which the parent is also going to have a portion. So we only look for what? The portion or the number of months or the number of years that the parent has acquired a subsidiary. If they acquired a subsidiary 6 months to the end of the year, you have to pro rata the revenue, the items one by one. If it is 9 months, you do 9/12 times the revenue. The same thing to the cost of sales. That is a statement of profit or loss. The statement of profit or loss, what are the workings that you need? The workings that you need is the group structure. That is the most important one. Whether you are preparing the statement of financial position or statement of profit or loss, you have to put a group structure there. So the group structure is telling us how the composition of the group. So the parent is having how many percentage in the subsidiary. You show that. You also show, so the percentage holding, you show the percentage holding of the parent in the subsidiary. You also show the date of acquisition. The date of acquisition. You show the date of reporting or the reporting date. Then you also show what we call the post-acquisition period. Okay, so we take them one by one. The date of acquisition is the day that the parents acquire the subsidiary or the parent obtain control over the subsidiary. The date of reporting is the day that you are preparing the financial statements. The post-acquisition period is the difference between the date of acquisition to the reporting period. So you can see that we acquired them 1st July. The reporting date is December. So this will now give us 6 months. So the post-acquisition period is a 6 months. So from the date of acquisition to the reporting date is what we call the post-acquisition period. Okay, what are some other workings that you have to do? The other workings will be the net asset at acquisition. Okay, the net asset at acquisition, depending on if the question is asking you to calculate for goodwill. So if they are asking you to calculate for goodwill, or they are giving you that the goodwill has impaired by 20%, it means that you have to know the goodwill before you can calculate the impairments. So the net asset at acquisition is very important. The calculation of goodwill is also important. Okay, that is if they have asked you to calculate a goodwill or you should get impairment on the goodwill. The question has stated that the goodwill has impaired by 20%. You don't know the goodwill figure. So what is the portion of the goodwill that is the 20%? You don't know. So you have to calculate the goodwill yourself. But if they have given you the goodwill impairment already, you don't have to go and do anything again. You don't have to go and do anything again. You don't have to do workings for the goodwill because we are not preparing statements of financial position. The other workings will be provision for unrealized profits, provision for unrealized profit or other things. Non-controlling interest is not needed. Group return earnings is not needed. NCI is not needed because we do calculation for those things and send them to statement of financial position. But here is the case, we are not preparing statement of financial position. We are preparing only statement of profit or loss. So the workings will be group structure, the net asset if you are asked to calculate goodwill, but the net asset will be at acquisition. Because reporting, we are looking for the post-acquisition profit. But the post-acquisition profit will be determined from the statement of profit or loss. So we don't do workings for the net asset at reporting. No. The net asset at acquisition is also important if you are asked to calculate a goodwill. If you are not asked to calculate a goodwill, or if you are not given an impairment percentage where you have to calculate the goodwill before you know the impairment, goodwill is not important. Goodwill calculation is not important. The only workings will be the net asset. I say the net asset, the group structure, very important. You can do the goodwill if you are asked to calculate the goodwill after I've said. The other workings will be provision for analyzed profits. Statement of profit or loss, don't go and do workings for NCI. Don't go and do workings for group return earners. Okay. So that is basically about a statement of profit or loss. What about statement of financial position? What about statement of financial position? What about statement of financial position? Okay, the statement of financial position, what we do now is that we don't do prorating. Like you'll be saying that the parent has acquired a subsidiary for only 6 months. So they are going to be taking 6 months of their asset. No, we don't do prorating in statement of financial position. If you are using a car from the beginning of the year to the end, and you decided to sell the car to me at the end of the year, which is 31 December, the car is no longer your car. The car is my own. So I'm the legitimate owner of the car. So for a minute. Okay. So the trick, okay, let me look at the trick for the statement of profit or loss. What you do is that you just add all the items, the cost, the revenue, the cost of sales, the revenue, the cost of sales. You bring the parent own first because you are putting the two together. So you bring the parent own first, then you add a subsidiary. If you count to administrative expenses, you do the same thing. Distribution expenses, you do the same thing. Finance costs, you do the same thing. Tax, you also do the same thing. But there are certain items that you don't put them together. The first one is the gross profit. No, we don't add their gross profit because if you do the calculation very well and you subtract your cost of sales from the revenue, you get a gross profit. The profit for the year also, we don't put the two together. We don't put the two together. The profit before tax, we don't put the two together. But their income and expenses, the items that we use to get our profit and those things are always put together. Are always put together. Okay. They are always put together for that particular issue. Let's come to statement of financial position. How do you go about it? You see, if you are given a question, don't even bother to go and read a footnote. Because if you read a footnote, it will discourage you. Some of the footnotes will discourage you. You are asked to prepare consolidated statement of financial position. You are going to put your assets, you are going to put your liabilities, you are going to put your equity there. So the first thing is that just identify the parent and then the subsidiary. Then you just add their figures down. So you'll be given the financial statement for the two entities. The first company, which is A or B, C, the first company will always be the parent. The second one will always be the what? The subsidiary. The third one will be an associate because this is financial reporting. For corporate reporting, it can be another subsidiary, but this is financial reporting. So you are going to be having only one subsidiary. Okay, so the first company will be the parent. This will be the subsidiary. We don't consolidate what the associate because the parent is not having control over the associates. So what you do is that the starting point is don't do anything. Don't go and do any workings. Pick your items, your assets, You can classify them non-current assets. What are the figures given to you? So maybe you are giving PPE. Take the parent figure, let's say 2,000, add the subsidiaries own to be 1,005. Leave it open. Go to the next item. Do you have intangibles there? Giving the statement given to you, put it together. Do you have any investment property or anything over there? Put it together. Then you go to current assets. What are the current assets given from the statement that you are given? Put the two together and leave it open. Inventory, receivables, and those things, put it together and leave it open. Go to the equity. The equity items, we don't bring the what? The subsidiaries own. Because the subsidiaries own will be consumed by the parent what? Purchase consideration. So we don't bring their equity items. The equity items will bring only the parent own. So take the parent share capital. What is the figure? Put it in a bracket and count to return earnings. Return earnings, you'll be doing workings for it. So just write the return earnings and move on. Then you have non-controlling interest. The non-controlling interest is the portion of the equity items that is not being purchased or that is not being controlled by the parents. Then you move on from that place to what? To non-current liabilities. What are the non-current liabilities given to you based on the statement? What are the items given to you based on the statement? You put them together and move on. Current liabilities, you put them together and move on. Then after that one, what will you come and do? You will come and the workings that you are going to be doing will be the group structure. So you put the group structure there. You put the group structure there. The next one will be the net assets. Okay, because you want to know the post-acquisition profit. So the net asset is for the calculation for the net assets is always for the statement of financial position. You also do the calculation of goodwill. Okay, you do goodwill calculation. You do NCI because all these figures will be shown in the statement of financial position. Then you will now do the group return earnings. Okay, you do the group return earnings. So you do the group return what? Earnings. These are the major workings that you'll be doing. You can have provision for unrealized profit and other items, but these are the what major workings that you'll be doing. Okay, so this is how you approach the question in the exam. You don't have to go there, be reading footnotes that will discourage you or that will bring your confidence level down. No. Boost your confidence level with these things, these additions before anything else. Okay, let's move on to, let's now pick a question to look at what we are talking about. So we are going to pick at least some 3 questions, two on statement of financial position, and maybe 1 on statement of profit or loss. Okay, so let's pick the question 1 to now look at what we are saying. Let's pick question 1. Who is going to read for us? Yeah, senior. Please, as your hand is up.
You were asking who to read.
Okay,
Oh,
okay.
sorry.
Okay, then read for us.
Okay.
Yeah.
Question 1. Efiduase acquired 600 million equity shares in Kumawu on 1st April 2016. The purchase consideration was made up of a share exchange of 1 share in Efiduase for 2 shares in Kumawu. The issue of 100 cedis 10% loan notes for every 500 shares acquired, and a deferred cash payment of 11% per share acquired payable on 1st April 2017. Efiduase also incurred directly attributable cost of 2 million cedis on acquisition of Kumawu. This cost comprised 1 million Ghana cedis, cost of issuing own shares. Charged to operating expenses is 1 million due diligence cost. included in the carrying amount of the investment in Kumawu in a fiduciary's own statement of financial position.
Okay.
A fiduciary, okay.
Okay. You can see that you have spent like 3 minutes reading the question, isn't it?
Yes, please.
So this is what you are going to do in the exam. No. You know that the first company will be the parent, isn't it? Okay. And the second one is what? Is the subsidiary. So as soon as you have the question, you know your parent and you know that you are going to be preparing statement of financial position. So what you do is that you just go straight forward and put your so you put the fiduciary group, then you have the consolidated statement of financial position. Then you put the as at. I'm not here to put the as at. Okay, so if you go there, you put the as at the date. So you count to the assets. You count to the assets. Then we have the non-current assets. So the non-current assets. So let's go to the question and pick those items one by one. So the non-current assets. What is the non-current asset? What is the value that we have there? The non-current assets are what?
Property, PPE,
Okay, so we have the
invest
PPE. So you pick the PPE. What are the figures? 639.
630,
Okay. Plus what? Okay.
340.
Okay. So the investment over there, you put it over there. It can be the investment in the associate. So you put a 1 to 1 there. Then you have intangibles, isn't it?
yes, please.
Okay, which is intellectual property. Intellectual property. How much is that?
121 million, and then Akumawu, no, nil.
Okay. So okay. The intellectual property is what? Is 30.
Yes.
Okay. It's 34. So let's put a 30 there. Okay. So you can write goodwill here because you haven't read the footnote. So you can also put investment in associate here. If there is no investment in associate, you just put dash there as a figure. Okay. Then from this place, you can now move on to your current assets. So the current assets, what are the current assets that we have?
Mm. 160 for a few.
Like they just put them together or they didn't, they just
They just
group
wrote
them.
current
They
assets.
just put them together, current assets.
Okay. So one what?
60.
160.
And subsidiary 70.
Okay.
Yes.
So we come to what? Equity and what?
Equity and liability.
Okay. Equity and liabilities. Okay. So the equity and liability we only show for the parents. So what is the share capital of the parents?
That's 300.
It's 300. Okay. $300. So the retained earnings will bring only that of the parents. Okay. Do we have any equity item again?
No.
There will be a premium share. A premium share.
Do you have anything under them again?
No, please, but the question, there will be a premium share.
Or anything that will happen again, it will be under the equity. It's either increase the equity or it will reduce it. Okay. So you just leave a space and count to the non-controlling interest. So let's come to the non-controlling interest.
Sir, your board is gone.
Is it coming?
Yes.
You can now see, isn't it?
Like I'm saying, yes.
Okay. So non-controlling interest, or you can put NCI there. Then what is the next item? We have non-current liabilities. We have non-current liabilities.
Your
Then
board is gone again.
Hey,
Okay.
is it for,
No, I guess he has to check his
Your
network
network.
because my own is in.
yeah. So non-current liabilities. So the non-current liabilities, what do we have? We have the 10% loan notes. Okay. So how much is that?
120 for parents
Okay, 120 for a parent,
and 20 for the subsidiary.
120 and 20 for the subsidiary. Okay. So let's go to current liabilities. Okay. So you have current liabilities. Okay. The current liabilities are what?
200 for the parent and 80 for subsidiary.
So 200 plus 80. Okay. So I hope we are done with the structure now, isn't it?
Yeah.
Okay. So you just go down to your workings. So you go down to your workings. So you go down to your workings. So the workings, the first one will be the group structure. Okay. So you can now go and read the question to see your group structure. So let's now take the question now to know the group structure. So you take the question now to know the group structure. So what is the number of shares that the parent is buying?
$600 million.
Okay, they are buying 600 million. The question is, what is the number of shares in the subsidiary? What is the total number of shares in the subsidiary? Someone should give us that figure.
Subsidiary 200.
That is a value, not number.
So it will
200
be 800
million.
800 million.
It will be what?
Okay.
800 million.
800 million.
How did you get the 800?
You divide the 200 by the 25 pesos
Okay,
each of equity shares.
okay. So you are issuing a certain number of shares for 25 pesos and you are getting the total value of 200 million. So what was the number of shares issued? Just is the total value by the share price. That's how we get it. So we can now calculate our parent holding. So we can now have the parent over here. We can have the parent, which is so the parents will have the subsidiary over here. Then the subsidiary is Kumau. So the percentage holding, we can calculate it as 600 over 800 times 100. What are we getting?
75%.
75%.
Okay. So NCL will be what?
25.
NCI will be 25.
Okay. So NCL will be 25. Or NCL will be calculated as 200 over 800 times the 100, 25%. Then you will now look at the acquisition date. So you put the acquisition date there. Okay. The acquisition date is what? When was the acquisition done?
1st April 2016.
Okay, so April 1, 2016. Okay, reporting date is what?
31st March
1st March 2017.
Okay, so March 3/1, 2017. Okay, so the post-acquisition period will be what?
12 months.
Okay, so that will be 1 year. So someone can write 1 year or someone can write 12 months. It depends. Okay, all right. So we have this one now. So the next thing, what will be the next workings that we think about?
Net assets of subsidiary.
So we have the net assets of the subsidiary. The net asset is always done for the subsidiary because subsidiary want to know the profit that was made during the what? The post-acquisition period. So you have at acquisition, and at reporting. Some people, they like putting post-acquisition profit at the end there. You can put it because me, I respect time. So I don't do that. I'll just find my net asset at acquisition and at reporting. Then I know that the only thing that can increase the net asset is profit. So I'll find a difference between the two figures. I'm going to save time. Okay. So we have the currency sign here, which are all in million. Okay. So what is the net asset? The net asset is always being calculated from what? From the equity side. You can also do total assets minus total liabilities, but the asset values given to you they are at reporting. So you don't know the value of the assets at the acquisition date. So we don't know that one. So we only use the equity side. So we use the share capital. You use the share capital. What is the share capital of the subsidiary at acquisition?
200 million.
Okay. Don't say that you are not giving at acquisition figure, so the share capital you don't know. No, we assume that there is no new issue of shares during the year because we want the parent to have what? 75%, a constant control. So if there should be a new issue of shares, it means that the parent's shareholding will now be reducing. But we assume that the parent will be having the same percentage of control. So there will not be any movement in the share capital. There will not be any movement in the share capital because if there should be a movement over there, the percentage holding will be reducing. So there will not be any movement in the share capital. So the share capital at reporting will still be the same as the share capital at what? Acquisition. The next one will be retained earnings. Okay. So what is the retained earnings at acquisition?
120.
120.
Is 120. So the first one is the balance brought down, which is the acquisition balance. So what will be the reporting balance?
140.
140. Okay. So you add the
340.
opening balance plus the profit for the year. 140. Okay. So you now scan through the footnote to see if you have certain items which are fair value adjustments. So you scan through the footnote to see whether you can get some fair value adjustment, which you are going to be what? You are going to be adjusting against what? So look, just leave the top. The top is talking about purchase consideration. It's talking about how the 75% of the shares of the equity shares of the subsidiary has been acquired, how the payment was done. Forget about that one. You
Hello, sir.
concentrate on that. Yes, senior.
Yeah, please, I want to ask a question.
Okay.
Why didn't you do adjustment to the retained earnings at acquisition?
Now they have given you opening and closing, so you just put them together before you come and do the other adjustment. So the other adjustment you know through reading the footnotes.
Okay.
Okay. So that one they have given you
Thank
the
you.
profit for the year, and they have given you the opening balance. The acquisition is a full year. Okay. Assuming the acquisition is just a 6 months, then what we do is we find 6 months of the 20 and add it to what? The 120. To now have the actual retained earnings at acquisition. But acquisition is a full year. So this is the opening balance.
Okay.
The 120 is the opening balance. Okay, Auntie Asama, your hand is up.
Sir, please. I'm not. Where did you get the share, the reporting date, the value for the share capital?
Or is this one? Is the equity
No,
item
you
here?
say the reporting date is waiting 20.
The return, this is the return earnings. Okay. The first one is the opening balance. That is at the start of the year, which is return earnings is 120. But during the year, they have made a profit of 20. So the profit will be added to the opening return balance, and we now have 140. That's how I have the return earnings to be 140.
Sir, please, I'm talking of the share capital.
Is the equity shares of the subsidiary, which is 200. Are you saying why the reporting is 200, the acquisition is also 200?
Say,
Can you hear me? Can you hear me? Please, can you hear me?
Constant. It doesn't change because if it changes, that means the parent has acquired a new shares and it will change the shareholdings of the parent. So the share capital is always constant. So at the inside the statement of financial position under Kumawu, the subsidiary we have 200. If you can see from there, we have 200 million there. So the 200 there, since it's constant at acquisition, it still be 200, and at reporting to it will still be 200. I hope you understand.
And
yes, I understand, but it was 280, which is the
280 where?
It's not 280, it's 200. Check equity and liability. Equity shares of 20.
Are you sure it's 280?
Okay.
Can you hear me?
yes, sir.
Can you hear me now?
Someone want to ask a question. Is that pantry now?
Okay.
Auntie Patrina.
Say,
Yes, please.
I said, please, I've been answered. You see, on the workings, I saw 280 at the reporting, but I think I didn't see it well.
Okay. It's 200, not.
Lights on and off.
Okay,
My board
thanks.
is gone. Oh, I have to start writing again.
Okay, so that is the authority and what? The question number one talks about the role and authority.
Okay. So they are saying that the carrying values, we calculate the net asset based on the carrying values. But they are now saying that the carrying values that we use, the asset is now having a fair value of 40 million, which is above the carrying value. So it means that if the carrying value of the asset is 80 million, the fair value will be 120 million. So we're supposed to use the 120 million, but we use only 80. So it means that we have to go and add 40 to the 80 to now make it 120. That is why we always add the upward fair value adjustment to the net assets. But this particular asset is a depreciable asset. It's a depreciable asset. And at the date of the acquisition, they are saying that it's 40 million. Okay, the fair value is 40 million. But they are saying that we have used these assets for 1 year. If the value was 40 million at the acquisition date, which is 1st April, 31 March now, that is 1 year. We have used the asset for 1 year. So the value will no longer be what? 40 million again. What is going to make it not to be 40 million is because of the wear and tear. We have used the asset for 1 year. So the 1 year usage is the depreciation that they are giving to you. The 1 year usage is the depreciation that they are giving to you. The depreciation has not been charged. Depreciation should have been taken from profit, but it has not been taken from profit. That is why we are taking the depreciation from the what? From the net asset at reporting, because the profit is always at the net asset at reporting. So the asset has increased by 40, but this has not been done. This has not been done. So the asset has increased by 40. This has not been done. So we go and we increase our asset by what? The 40. Because all these value over here are based on their carrying value. Now they are saying that the asset has increased by 40. So you go and add a 40, then you come and reduce your depreciation of what? 2 million. The meaning is that the value of the asset now will be 38 because we have used 2 million out of it. That is the basic issue about it. Auntie Bennett, I saw your hand up.
Sorry, I think it's the old one.
Okay. So that is basically about that particular issue. But the question can also say that the fair value adjustment has been taken into consideration already. The fair value adjustment has been taken into consideration. So the meaning is that they has already added what? The fair value to the asset that they have in the statement of financial position. So if that is the case, your net assets, where can I get the net assets? So if they say that the fair value adjustment has been taken into consideration already, it means that you only have 40 over here, but 40 will not come here because they have already added it to their net asset as reporting because they have already adjusted the fair value adjustment. So you have to be very careful with that particular issue. But if they say that it has not been adjusted, then you have to come and do the writing. Your asset has increased by 40. You go and add it to the 40. You have used 2 million out of it. It means that the value is going to be reducing. So you adjust it as such. Any question before we take the second footnote?
So please, if you can repeat that portion again.
Okay, I'm saying that sometimes the question can say that it has already been taken into consideration.
Okay.
Okay, if they say it has already been taken into consideration, it will be taken into consideration after the acquisition. So you bring the 40 over here, but the 40 will not come at reporting because they have already added it to their assets.
Will not come under reporting.
It will not come under reporting.
Okay.
So it means that they have already added it to their assets. They have done everything on it already, and the depreciation too will not come. The only figure that will come is the 40 at acquisition. Okay. Let's take the second footnote.
The intellectual property is a system of encryption designed for internet use. Kumawo has been advised that government legislation passed since acquisition has now made this type of encryption illegal. Kumawo will receive 10 million Ghana cedis in compensation from the government.
Okay. What is happening here? What is happening there? What is the value of the intellectual property in the statement of financial position?
It's 30.
Okay.
30.
Okay. What are they saying now? They are saying that the intellectual property is a system of encryption designed for internet use. Kumawo has been advised that government legislation passes acquisition. So that the government has passed what? A legislation since acquisition, but that legislation has no effect on the what? On the intellectual property. Has now made, when is the now? Now, when is the now that they are reporting? Is the reporting date, isn't it?
Reporting date, yes.
Okay. So it means that the impairment condition was there from the what? From the acquisition date. But it is now, which is the reporting date that the asset has actually been impaired. So we have a situation there which has been passed since acquisition, but it is now making the what? The intellectual property to be what? To be impaired. So at the reporting date, we have to carry out an impairment test on what? On the property. So it is now that the people are saying that this is what? Illegal. It is now, not at acquisition date. It is now. So reporting. Okay. We have what? We have 30. How much are we receiving from the government?
10 million.
We are receiving 10 million, isn't it?
Yes, please.
So it means that we are going to have impairment of the intellectual property, isn't it?
Yes, please.
Okay. Has that been taken into consideration?
No, please.
No, please. So we have to come and subtract the 20 from this side as the impairment. So if you go to the intellectual property, what do we do?
You subtract
20 from it, isn't it?
Yes, please.
Okay. So we now know this is the amount that we are receiving from the government. But the question didn't say the heading states when you are going to receive the money. So if they state when you are going to receive the money, then you can bring the intellectual property as a current asset. But it didn't state the date. So you still maintain it as what? As the non-current asset. But if they say they are going to receive it in 2 years' time or 3 years' time, then you now bring it to be what? To be a current asset. Auntie Joycelyn, your hand is up.
Yes, please. I hardly get the intellectual property, the adjustment we just did. You said it is an impairment.
Yes,
and
please.
I'm not too clear why it is an impairment because the cost is 30
Okay.
now.
And
Please, I
the
just need a
and
further
then
explanation.
and then the net realizable value is what? How much are you receiving from the government?
Okay, it's 10, so there is actually an impairment.
Okay.
There's actually an impairment. So please
So,
just go over the adjustments for me again.
okay. The impairment has not been adjusted against the profit. If it should have been adjusted against the profits, the company will not be having 30 over there. They will not be having the 30. So it means that it is the reporting date that we are going to do the adjustments now. So we are going to be reducing the what? The intellectual property by what? By 20, and also the profit to be reducing by what? By 20. So that's why I've subtracted the what? The 20 from the reporting figure and also the 20 from the intellectual property. Okay.
So I think you subtracted 20 because at the end of the day, we have to reduce the assets, the net realizable value.
Exactly.
I think that is so. Thank you.
All right. Okay. Another way of looking at it is that you can see that in the net asset at reporting, we are including what? 30. It's 30. But they are now saying that it should be what? 10. So what do? We go and reduce it by 20. That is also another way of looking at it. In the net asset over there, we use 30 instead of 10. So we go and reduce it to the 10. That is another way of looking at it. So let's count to we somehow done with the net asset. Let's go to goodwill calculation. Okay. So the goodwill calculation, we can now look at the goodwill calculation by taking the purchase consideration. Okay. Okay, so the purchase consideration, the information given about them is at the top. So you can ignore the goodwill calculation for now and take the other footnote to move on. Okay, the C is what? Auntie Patrina, are you there?
Sir, can I come in?
Okay, Sina.
Yeah, the intellectual property, I'm looking at it in a way that since it has become illegal, I was thinking you impair everything but recognize a receivable from the government of 10 million. Or less than that.
Okay, that is also not bad. The difference is that you are going to, the balance will be 10, isn't it? So
Yeah.
since it's illegal, you can derecognize everything and now have a receivables of 10. That's also not bad. That's also not bad. Okay. Okay.
Okay.
All right. Thank you. Okay. So that should be okay. That is also not bad. The company will receive in compensation from what? From the government. So that will also be receivables. But just that they didn't state when we are going to receive the money. So you can just maybe receivables in respect of intellectual property or anyhow that you put it. The receivable too is not bad. Okay. That is not bad. Let's look at the C. Let's look at the C. Okay. So
See,
yeah.
see, a fiduciary policy is to value the non-controlling interest using its proportion of the fair value of subsidiaries' identifiable net assets.
Okay. So what is the what? What is the value of the net asset at acquisition?
You need to know the historical cost of the item or the current price or the current consideration that will be
Okay, what is the net asset value at acquisition? The net asset at acquisition, what is the total?
360.
Okay, so they are saying that they are using proportionate method. So what will be the NCR portion of the 360?
That would be 25% of it.
Okay, 25% times what? 360, isn't it?
That would be 90 cedis.
Okay, so the proportionate means that you will share the net asset among the parent and then the NCA in their percentage holding. So NCA will be having 20%, the parent will be having what? 75%. So that will give us 90 million. Okay, so we can put our NCA there. Then you can also put the group return earnings there. The group return earnings also there. So the group return earnings is for the parents. So you bring the parents return earnings. What is the total for the parents return earnings? What is the total for the parents return earnings?
One
300.
Would that be 300?
300.
Is the parent 210 and 90?
210 and 90.
Okay. So that would be 300.
We can link into
So 210 plus 90.
fulfillment. How? We are saying that
Linus,
Yes, please.
operational capacity is
please that
the cost that we are going to.
hello,
Yes, please.
Linus.
Yeah.
Yeah, I want to ask the 360. The 360 you got. I want to know what it is.
For the 360, just the total of the net asset, 200 plus 120 plus 40.
Okay.
Okay.
The financial capacity. Okay.
Okay. So let's look at the. So we are done with the net asset also. We are done with the NCA also.
We are talking about
Hey, Charlie, your this thing is making noise, so it's disturbing. Okay, so we are done with that particular footnote, which is talking about the NCA proportion. Sometimes they can say the NCA is what is they are using full goodwill method, so they will give you the fair value of the NCA. But this one they are using proportionate method. At the date of acquisition, you share the net asset between the parent and the subsidiary in their percentage what? In the proportion of their percentage holding. Okay, let's look at the D. Let's look at the D.
At the beginning of this year's second quarter, a fiduciary obtained a 25% equity interest in Asokori. In exchange for this investment, a fiduciary transferred a parcel of land with a book value of 30 million Ghana cedis and a fair value of 36 million Ghana cedis as at acquisition date to Asokori's former shareholders. A fiduciary has not yet recorded this transaction, but the associated professional charges of 0.5 million Ghana cedis have been included in a fiduciary operating expenses. During the current year, Asokori reported annual profits after tax of 5.5 million Ghana cedis, though it is first quarter's interim accounts. This year had shown a loss after tax of 2.5 million Ghana cedis.
This is too much. Why? Okay, so they say at the beginning of this year's second quarter. What do they mean by this year's second quarter? They are talking about a reporting year, not the calendar year, no. So they are talking about at the beginning of this year's second quarter. What is the start of the year? The financial year. What is the start of the financial year for the parents? Their financial year always starts from what?
1st April.
Okay.
Oh,
okay.
Yeah.
So they are saying that at the beginning of this year's second quarter. So what will be the first quarter? April to when?
June.
April to June.
April to June will be the first quarter for the year, isn't it? Okay. So at the beginning of the second quarter will be when? We'll start from when?
July to September.
We'll start from July. That is very important. Okay. So what is the percentage holding that they are having?
75.
No place.
25.
Okay. The 25 is what? 25 will give them what?
Significant influence.
So that particular investment will be accounted for as what? Investment in what? In associates. Okay. So how much are we paying? What is the purchase consideration? Are we paying cash or we are giving them? Or are we paying them in cash or kind? What is the question saying?
In kind transfer of land.
Okay. So are we going to give the land to them? Are we going to give the land to them at fair value or at carrying value?
At fair value.
At fair value. If I'm owing you, I know that if I want to sell this land, the land is what? The value of the land is 30 million. But if I want to sell it in the market, it's 36 million. So if you want me to use the land to pay you, it means I have to give the land to you at the 36 million. So they will pay with the what? With the 36 million. Okay. They will pay with the 36 million. Okay. But the question is, what are they saying about this particular transaction? Has it been recorded? In exchange for this investment, FEDRC transferred a parcel of land with a book value of 30 million and a fair value of 36 million as at acquisition date to the former shareholders of those people. FEDRC has not yet recorded what? This transaction. So it means that the transfer of the land has not been what? Has not been recorded. If you should record the transfer of the land, what are the entries that you are going to be doing? This particular transaction, look at it. What are the entries you'll be doing? How will you treat this particular transaction? That's what you have to do. How will you do it? What are the entries? Which of them are we debiting? What are we debiting? The land, who are we giving the land to?
To the associates.
Okay. And what we are giving the land for in a return for what? We are giving the land in return for what? We are giving the land in return for what, seniors? We are giving the land in return for what?
For equity shares.
For equity shares, isn't it?
Yes.
Okay. So the equity shares, how will it be treated? It will be treated as what? It is likely to be a financial asset, isn't it?
Yes, please.
Okay. So if we are giving the shares for that, what are we going to do? What will be the entries that we'll be doing?
You have to use fair value method to account for it.
Okay. So what we do is we debit the asset, which is the investment in associate. Okay.
Yes.
My board is gone, so I can't start writing again. So those of you writing, I'll just adjust those items so that you get it because my board is gone. I can't write again. Okay. So what we'll do is we are going to be debiting the investments in associates. We're debiting the investment in associates. With how much? 36 million, isn't it? 36 million. But what will happen? We are now going to remove the land, isn't it? So we credit the PPE. It means that we are giving the land out. We credit the PPE at 30 million. It's just like we are selling the land. That is the basic assumption about it. Just like we are. Yes, my network is worrying me. Please, can you hear me?
Yes, we can
Yeah, we
hear
can hear
you.
you.
Okay. My network is worrying me, so right now I have to let's start. Okay. So we are saying that we are going to be debiting what? The investment. We debit the investment. So debit the investment, which is a financial asset. Debit the investment at 36. What are we going to do? What will be the corresponding entries? Just assume that you are selling the land. What will be the corresponding entries that you do? You debit cash, isn't it? The cash over here is the investment. Okay. What is the next thing that you are going to do? You credit what? If you have a land and you are giving the land out, will you still have the land?
Yeah.
If you have a land and you are
Oh.
giving the land out, will you still have the land?
Relative. It's found what the definition
No,
of
no.
stock or contract.
Please, can you hear me?
Yes, you can hear me.
My network is bad. So you credit PPE with 30. Then you also now have a gain of what? You now credit the retained earnings with a gain of 6. So it's just like you are selling the land. The land is having carrying value of 30. You are now giving it to someone at 36 million. It means that you'll be having what? A gain of 6. So you take the gain of 6 to retain earnings, which is the gain on the transfer of the land, which is 6 million. Then you now go and remove the 30 from what? From the PPE, because it has not been removed. So you go and remove the 30 from PPE and also remove the what? And also credit the retained earnings as a gain, because the land is 30 million, but you are giving it to someone as what? 36. You are having a gain on the transfer as 6. That particular gain will go to what? Retained earnings. It's supposed to go to profit, but we are not preparing statement of profit or loss. So you have to send it to retained earnings for the parents. But the land will no longer be there. But they haven't removed the land from the statement. They haven't removed the land. So you go and remove the 30 million from the land and you add 6 million to what? To the retained earnings as a gain. Okay. Let's now count to what they are saying over here. Yes, Jocelyn.
And please take that part again, please.
Okay. So you have an asset of 30 million. You are giving it to someone 36 million. What is happening there? You have a gain of 6 million, isn't it? Okay. So if you have given the asset to someone, are you still going to be the owner of the asset? No. But they are saying that the asset is still in the PPE. They are here to record this particular transaction. It means that the asset is still in the PPE. So you go and remove the 30 million because it is a 30 million that is in the PPE. The asset is in the PPE at the carrying value. So go and remove the what? The 30 million from it. Then you also send a gain of the 6 million to what? To the retained earnings, because you haven't recognized the gain. You are here to recognize the transaction. So the gain is still not recognized. So you do it like that. That is all. All right. Okay. Okay. During the current year, the company reported what? Annual profit after tax of what? 5.8. Though its first quarter interim account this year had shown a loss after after tax of 2.5 million. Okay, what are they saying is the profit? What's the profit reported for the year? 5.5, isn't it?
Okay.
The profit reported for the year is 5.5. Oh. The profit reported for the year is what? 5.5, isn't it? Yeah, please, are we here? Oh, the network is worrying.
Yes, the profit is 5.5.
Is the network worrying, or is my voice coming, or is breaking down?
Your
Network.
Six. I'm coming. Let me see whether I can work on it. The profit for the year is what? What is the profit for the year reported?
5.5.
Okay. That is the profit for the year. 5.5 for the year. Okay. 5.5 for the year. But what are they saying? This is the total profit for the year. What are they saying? What are they saying? They are saying that the first quarter interim accounts this year had shown a loss after tax of what? 2.5, isn't it? Okay. So the question now is, we want to know the actual profit that was made during the year. Okay. The total profit, which is what? Which is the 5.5 over here, is for the full year, which is the first 3 months, which is the pre-acquisition period plus the what? The last what? 9 months. So it will be the first 3 months because we acquired them at the beginning of what? The second quarter. So we acquired them for only 9 months. Okay, they have already done what? 3 months already. But they are saying that if you put the 3-month profit together with the 9-month profit, which will give you the 12 months, it is 5.5 million. Okay. But the question is, these 3 months, was it profit that was made or it is a loss? The first 3 months,
Loss.
it was a loss of what?
2.5.
2.5. Okay. So it means that they made a loss of 2.5, and with the 9 months, they made a profit. So they subtracted the loss from the 9 months profit, and they are now getting what?
Yes, I cannot see the loss.
The loss is in the question there. They have given the loss there. They are saying that though its first quarter interims account this year had shown a loss after tax of 2.5. Can you see the loss now?
Yes, please, I've seen it now. Thank you.
So the 5.5, which is the profit for the year, is a full year profit. That is the full year profit for the 12 months. But how did we get this particular profit? It is the what? The summation of the pre-acquisition profit and also the post-acquisition profit. The pre-acquisition profit will be for 3 months. And the question says that it is a loss for 2.5. Then we add the post-acquisition profit, which is the 9 months, and we are getting a total of 5.5. So in actual sense, what was the profit made for the 9 months? What would be the
8
total
million.
profit? Okay, it was a profit of 8 million made for the 9 months. So that if you take the profit for the 8 months and you take the 12.5 loss from it, you now have the total profit of 5.5. So it means that the post-acquisition profit over there is 8 million. The post-acquisition profit is 8 million, which is what? The 9 months. So your investment in associates, which we have started, the investment in the associates, which we have started already. So we have the fair value at acquisition. That was 36 million. You will now bring the share of the associate post-acquisition profits. And that would be the 8 million, because the 8 million is for the 9 months. So you don't have to do 9 over 12 times anything. No. You only do the 9 over 12 if the 5.5 is the actual profit for the whole year. But this 5.5, there was a loss during the pre-acquisition period, and we now have a total profit of what? 5.5. The meaning is that we have made a profit of a certain amount and we have subtracted a loss of 2.5 from it. That is how come we had the 5.5. So the profit for that particular period will be 0.25 times the 8 million, which is the post-acquisition profit. How much are we getting?
$2 million.
Okay. So these 2 million also will go to group return earnings. So let me do the group return earnings over here. Since the board is gone, let me just put some of them over here, the group return earnings. So the parent figure, the parent's return earnings was 300. So we look at the gain on the transfer of the PPE. The gain on the transfer was 6. The share of the associate, share of associate profits will come here, which will be 2 million. We add it. Okay. So that is all about that particular question. So you have to know your fair value of the investment in associates and also the share of the profit that you'll be having. Let's go to the last one before we go to the top to calculate our goodwill. Okay. Zina Sharif, can you take the E for us?
The E. At year end, Socorro's inventory included items worth 1.2 million Ghana cedis bought from Kumawu. These items had cost Kumawu 0.8 million Ghana cedis.
Okay, what is happening here? Who is trading?
Associate and subsidiary.
Okay. You see, whatever be the case, the subsidiary, if the subsidiary is trading with the associate, you just assume that it is the parent that is trading with the associate. Why? Because the parent is the owner of the subsidiary. Okay, so this transaction will be accounted as if it is the parent that is what? Trading with what? With the associate. Okay, so the goods sold to the associate cost what? 1 point. The selling price of the goods sold is 1.2, isn't it? The selling price of the goods sold is what? Please, can you hear me?
1.2 million.
1.2.
Yes.
The cost is what?
The cost is 0.8.
Okay, so what is the profit element on it?
0.2. No.
0.4.
0.4, isn't it?
Yes.
Okay, so this 0.4 profits, what we do is that the subsidiary will only take the parent portion of it, which is 25%. So that's 0.4, you find only 24% on it. You find only 25% on it. What are you getting? Okay, it's 0.1, isn't it?
Yes,
Yeah.
0.1.
Okay, this 0.1 is the unrealized profit, isn't it? Okay, this unrealized profit will be treated under the net asset of the subsidiary because it is the subsidiary that is selling. So you will come to the net asset of the subsidiary, which at reporting, you will subtract the what? The 0.1 from the net asset as reported. But that particular 0.1 will now become will be taken from the investment in associates because we assume that the parent is the one trading with the subsidiary, but just that the parent will not suffer for the provision for unrealized profit. It is the subsidiary that will suffer for it. The subsidiary will be the one that will bear the unrealized profit. So you debit the investment in associates. You credit the investment in associates, then you debit the net asset of the subsidiary. That is about this particular one. Let's now go to the top and tackle those situations to know our goodwill and other issues. So for the footnote,
So you
okay,
debit the subsidiary.
the net asset of the subsidiary Or you debit the
Hello, sir.
okay. Yes, please.
Hello, sir, please. You've debited the net asset of the subsidiary.
Yeah.
So won't you also go and reduce it with the inventory?
No. That those people is not part of the associate is not part of the group. So the
Okay.
inventory
So it's
is not,
because the subsidiary is selling to the associates, it will not hit the financial statements.
yes, the inventory that the subsidiary is selling to the is selling to the associate is not part of the inventory in the statement of financial position. So the unrealized profit is in the books of the associate, not in our books. Okay. So we don't do anything to the inventory because the associate is not part of the group. The associate is not part of the group. Or in other words, the unrealized profit is not part of the inventory in the books of the parent and the subsidiary. It is included in the inventory that is in the books of the associate. And the associate is not part of the group. Okay, so you debit your retained earnings, then you credit the investments in the associate of 0.1. Okay. Let's now take the top. Let's now take the top.
Please, one more thing.
Okay.
Yes, I see that you are taking it to retain earnings also.
The retained earnings will be for the associate. That is the reporting figure, the net asset at reporting, not the parent retained earnings.
Not the parents with okay.
So the person who is selling will be the one that will bear the unrealized profit.
Okay.
All right. Okay. So let's read the top and
Figures, should we start at the one?
yeah, let's start from the one.
Fiduciary acquired 6 million equity shares in Kumawu on 1st April 2016. The purchase consideration was made up of a share exchange of 1 share in a fiduciary for 2 shares in Kumawu. The issue of 100 Ghana cedis 10% loan note for every 500 share acquired, and a deferred cash payment of 11 pesos per share acquired, payable on 1st April 2017. Fiduciary also incurred direct attributable costs of 2 million Ghana cedis on acquisition of Kumawu. These costs comprised 1 million Ghana cedis cost of issuing own shares, charged to operating expenses, 1 million Ghana cedis due diligence cost included in the carrying amount of the investment in Kumawu in a fiduciary's own statement of financial position. A fiduciary has only recorded the issue of the loan note. The value of each fiduciary share at the date of acquisition was 75 pesos, and a fiduciary has a cost of capital of 10% per annum.
Okay. So you can see that they are using 3 ways of settling the purchase consideration, isn't it?
Yes.
The first one is share exchange. How many shares are they buying?
600.
Okay. But they are asking they are giving them new shares, or they are giving their own shares in the ratio of 1:2, isn't it?
Yes.
Okay. So the meaning is that we are telling you that we are buying 600 shares. Bring 2 of those shares for 1. So how many of the shares are they going to be bringing the 600 for in the fiduciary? How many shares would the fiduciary be giving to the shareholders of Kumawu in the ratio 1?
300.
That will give us 300 million. So the purchase consideration will be calculated. The share exchange is always calculated as, I will show you the simplest way of going about it. So if they say 2 for 3, it's just the 2 over 3 times the number of shares that they are buying. So we have the share exchange. So the share exchange, we are buying 600 shares. So 1 for 2 will give us 1 over 2. The meaning is that bring 2 of your existing shares. Your existing shares that we are buying is 600, bring 2 of them for 1. So it means that we are going to be giving you 300 for 600 shares. So 1 for 2 will give us 1 over 2 times 600. Okay, so we are giving you 300 million shares, isn't it? Okay.
Yes, please.
But the question is, we want to know the value of those shares. We want to know the value of those shares because the shares will be valued. The 300 shares, how much will it be valued? We want to know the value of those shares. So what is the market price of the shares for Efiduasi?
75 pesos.
Okay, at the date of the transaction, it is 75. So you multiply by the parent what share price, which is 0.75. What are we getting?
225.
We have 225. Okay. Has this particular transaction been recorded?
No, please.
No.
So what do we do? How do we record this?
We have to debit the goodwill,
We have to debit the investment, okay?
the investment, and then we have to increase the share capital.
So we have to increase the share capital. So what will happen is that you go and add the 225 to the share capital. Then you also add this one to the investment. You can see that we have brought it over here under the purchase consideration. So you go and add the 225 to your share capital, the parent share capital, because their share capital will now be increasing. They are now going to be having a new shareholders in addition to the existing ones that they have. So you go and add it over there. Let's count to the next one. The next one, what are they saying there? The issue of 100% loan notes for every what? 500. For every 500 shares acquired. How many shares do you acquire?
6 million. 600. Yeah, 6 million.
Jocelyn, your hand is up.
Yes, please. I wanted to be sure, the purchase consideration, the share exchange. So that means we'll take the value of 225 to go and add to our equity shares,
Exactly.
the parent equity shares. That's what it is.
Yes, please.
Okay. And then the other entry that you were making, I didn't get that one.
We just bring it under the purchase consideration.
Oh, okay. This two. Okay, sure. That's okay. Thank you.
All right. Let's come to we are buying 600 million shares. Okay. But how much are we giving for? They are saying that for every 500 shares, we are going to be having 100 cities, isn't it? For every 500 shares that we acquired, they will give, for every 500 shares that we acquired, we give them a loan note of what? 100 cities. So 100 cities for every 500 shares. So we have acquired 600 shares. We have acquired 600 million shares. And they are saying that for every 500 of the shares that we acquired, we are going to be giving them a loan note equivalent to 100 cities. So the question now is, what will be the total value of the loan note that we are going to give to them? It's also very simple. You ask yourself, the 600 million over 500, then you multiply by 100. What are we getting? What are you getting?
120.
120. Or another way of doing this is that if 100 cedis is equal to 500, how many cedis will be equal to 600 million shares? That is also ratio and proportion side. Okay. That's
Okay.
one side of going about it. It's not anything difficult. It's not anything difficult. Okay. So that is one side about it. So you can see that they say that the loan note has been recorded, isn't it? Only the loan note has been what? Has been recorded. So you can see that that is the reason why we have the 121 over here. Okay, so the loan note has already been recorded, so we don't have to do anything. So we just bring the 120 here. Okay, Let's now look at the next one, which is a deferred consideration. So we are having a deferred payment of what? 11 pesos per share acquired payable on 1st April 2017. When is the acquisition date?
1st April.
1st April. Okay. When are we paying this a particular amount?
April 2017.
So how many months from the date of acquisition?
12 months.
12 months. Okay. The question is, how much are we paying in 12 months time? We need to find that particular amount. How much are we paying in 12 months time? It will be 11 pesos, which is 0.11 times what? The 600 million. Am I correct?
Yes, please.
Okay. So how much are we getting?
66 million.
Okay. We are getting 66 million. But when are we paying this 66 million?
9 years.
Okay. But the question now is, if we should have cash today, are we going to pay the same 66 million?
No, please.
So it means that they have added interest to the actual amount that we're supposed to pay for the shares, isn't it?
Yes.
So since you are going to be keeping someone's money for 1 year, the person will factor in the interest that the person should have earned on that particular amount. So what we do is that we always present value the deferred consideration. The deferred consideration is always having a finance component. So we find the present value of that particular figure, which will be the 66 divided by the cost of capital. It's just like normal present value. Future value divided by 1 plus r exponent n, or future value multiplied by 1 over 1 plus r exponent n. So we just use a normal present value method. So we now be having the deferred consideration to be deferred consideration will now be 66 divided by 1.1 because it's just 1 year, and the cost of capital of the parent is 10%. The cost of capital of the parent is 10%. So what is the present value of that particular amount?
60 million.
Okay, 60 million. So it means that we are going to be paying interest of what?
6 million.
Okay,
6 million.
so we have done a full year already, isn't it? Today is 31st March 2017. It means that the 66 will be paid the next day, isn't it?
Yes.
Okay, so it means that we have done the full year already. So from the date of acquisition to this one, we have done a full year. So we have to come and take the finance cost from the retained earnings because it's the parent that is deferring the payments. Okay, has the deferred consideration been recognized?
No, please.
So what do we do to
Yes.
has the
No.
deferred consideration been recognized in the books of the parents?
No, please.
Okay, so what do we do?
So we'll record it.
At what
But
amount?
take it
We
at what
add the finance cost to the deferred
plus
consideration.
Okay,
plus yes.
which will be 66, isn't it?
Yes, please.
Okay, and this amount will be paid the next day. So where do we put it?
It will be current liability, another current liability.
So we add it to the current liabilities figure. Are we okay? Because it will be paid the next day. So that is a current liability. Okay. So that is about the first consideration. The major issue that I want to talk about is this particular one. FEDUSC also incurred direct attributable cost of 2 million on acquisition of Kumau. This cost comprised 1 million cost of issuing own shares, charged to what operating expenses, and 1 million due diligence cost included in the carrying amount of the investment. So you can see that the investment that we have over here is how much? What is the
121.
investment? Okay, which is the loan plus the 1 million. The loan is 120 plus the 1 million that they are saying that they have included there. Are you getting the issue? So it is the 1 million plus the loan figure that is included over here, which is the 121. But the due diligence cost, the standard says that any cost that is incurred on acquisition, it can be acquisition cost, it can be professional charges, it can be any other cost. It should be expense. So the due diligence cost should be expense to profit or loss. It should not be capitalized. However, any cost that the company incurred on issuing of its own shares should be treated as a transaction cost in accordance with IFRS 9, financial instruments. So the due diligence cost should be expense, but the cost of issuing own shares to be what? To be capitalized. But what do we do? The reverse it, isn't it? Look at the question. What did they do? The cost of issuing its own shares has been charged to operating expenses. It means that it has been charged to profit or loss. But the cost that should have been charged to profit or loss is the what? Is the due diligence cost, which is 1 million. Okay. So what we do is that the due diligence cost will be removed. Will be removed from this place and charged to what? Profit or loss. Okay. And the issue cost over here will also be reversed from the profit or loss. So what you do is the retained earnings of the parents, you will have a figure like this. You have a due diligence cost. You have a due diligence cost of 1 million. Then you now have a reversal of the cost of issuing its own shares. So that will be 1 million. You can see that the cost of issuing its own shares has been charged to profit or loss, which should not have been charged. So we go and subtract it. We go and add it back because it has been subtracted from the profits. But it is the due diligence cost that should have been charged to profit or loss. And they have capitalized it. So we now have to go and subtract it from the profit. You can see that at the end of the day, this is having a zero effect, isn't it?
Yes.
So you can decide not to bring it at all because you have already subtracted the 1 million. You should have subtracted 1 million. You have already subtracted that 1 million. So you don't have to go there and do any adjustments because any adjustment that you are going to be doing will be having a zero effect. But what will happen is that the cost that is included in the investment, the cost of issuing its own shares should be treated now as transaction costs in accordance with financial instruments. If the company is issuing equity shares, would that be an asset or liability?
Asset.
Hey, the company is issuing, it's not a company that is buying. The company is the one issuing. People are going to buy.
It's
Is it going to be a liability or asset? Business entity concept.
A liability.
It's a liability. Okay. If it is a liability,
It will be taken out of them.
yes. If it is a liability, how is transaction cost treated under liability for financial liability? It is subtracted, isn't it?
Yes.
So the 1 million will be taken from the what? The share capital of the parent. So the cost of issuing shares should be subtracted from the share capital, and any other cost should be expensed relating to the acquisition should be expensed. So you take the 1 million from what? From the share capital of the parent. That is all about that one. So the cost of issuing, take note of that. Cost of issuing its own shares or its own securities, the cost that the company incurred as a result of issuing its own securities under the acquisition will be treated as a transaction cost under financial instruments, where it will be taken away from the what? The amount realized from the issue, which is the 225. You take the one from it before you go and add the 224 there. But any other cost will be expensed as incurred. You have to take note of this. Auntie Jocelyn, your hand is up.
Yes, please. I'm a bit confused here. Just as you rightly said, the financial instruments, the issue cost in terms of equity, the issue cost should be added to the actual cost of the shares.
That is asset. If you are
Sorry.
if you are buying equity shares, that will be an asset. So you add. But this one is the company that is issuing. People will buy. So the people are, it is now seen as what? As a liability because people are using their money to buy your security. You are owing them. So under the business entity, capital is treated as a liability. Equity is treated as a liability because they are the owner of the company, but the business is separate from them. So if they are having their money in the business, it is like the business is owing them. So it will be a liability to the business. So the equity, if you are issuing equity, we only add the issuing cost if the equity is a financial asset. If you are buying the equity, it means that is an asset. So if you want to capitalize your transaction cost, it means that you have to add. But here is the case, you are issuing. So this is more like a liability to you. So the transaction cost will be subtracted, not added. So don't confuse it.
Okay. So that's why we are reversing it, because in the financial statement, it has been added.
No, we are not reversing from the share capital. What they did was this one. Okay. What they did was, instead of them subtracting the issue cost from the share capital, they have taken it from retained earnings. So it should not be charged as profit as an expense. So they have charged it as an expense. So what we do is that we go and reverse it because it should be capitalized. So you go and add it to the what? To the retained earnings, because it was first taken as what? As an expense, which reduce the profit. So you go and add it back to the profit, which is the retained earnings. Then you will now come and subtract it from what? From the share capital. So the double entry, okay, let me put a double entry there, is you debit the share capital, then you now credit the retained earnings with 1 million, 1 million. Okay, so that is how we go about it. The issue was the debit at the time of transaction, the debit profit or loss, 1 million, and the credit cash, 1 million. But this particular figure should not be debit profit or loss. This is the correct thing that they have done in respect of that particular transaction. At the time, the debit profit or loss as an expense, and they credit the cash. But they should not debit profit or loss. They should debit what? Equity. So it means that they have done an error here. So how do we reverse this particular error? It means that we now have to come and debit what's supposed to be debited, which is 1 million. Then we now reverse the credit to the retained earnings of 1 million, which is a profit or loss. So that is how we go about it. We just reverse it because it's supposed not to be done like that. Okay, let's come to the next cost, which is the due diligence cost. The due diligence cost, the time that they incur it, they debit the investment of 1 million and they credit cash, 1 million. The investment should not be debited. It should have been charged to profit or loss. So how do we reverse it? We now debit the item that should be debited, which is profit or loss, 1 million. Then we now credit the item that should not be debited but was debited, which is the investment, 1 million. So you can see that we are ignoring this because this will not be affected. The cash will not be affected. So we just reverse it, just like a double entry. Very simple. Auntie Jocelyn, are you still confused or I should move on?
It's better. So in this case, we are not preparing P&L. So that means we'll go and we'll put it at retained earnings of the parent.
Exactly.
Sure. Thank you.
Okay. So let's look at our purchase consideration. Let's look at our total purchase consideration. What are we having as a total?
$405.
405. So what will be the net assets? Let's find a goodwill. Would that be 0.75 times 360?
Yes, that's correct.
Okay. Our net asset at acquisition was 760. So what are we having as a goodwill?
$270.
The goodwill is, I'm having 135.
Yes, that's right.
Okay. There was no impairment on the goodwill. At least we should have do it as a working, but my board went off. I cannot rewrite again. So, but just that the adjustments, since we explained the footnote, that will be better. It's a very simple question, but somehow complicated. There are a lot of issues that have been examined over here, or there are a lot of issues that have been tested over here. Take your time, go through it again, because anything is possible. Okay. All right. So take your time and go through it again, because anything is possible. Let's look at the questions.
Please, I have a little concern.
Okay.
I joined a bit late, but I want to be clear on how we treated the contingent compensation, the compensation issue. Was it treated or ignored?
Which one? There's no contingent here. The deferred consideration.
Yeah, I think note B, where Kumewu will receive 10% for the compensation that the government
Oh, we
gave
have
them.
we have done that. We reduce our property by 20. The property was carried at 30 million. The intellectual property was carried at 30 million. Okay. They are saying that the government will receive what? The government will give them 10 million. So what we do is that we go and take the 20 million from the 30 million and remaining what? 10 million. And one person suggested that we can remove all the intellectual property and now put a receivables over there as 10 million. That's all.
Oh,
So,
okay, noted.
okay, that has been adjusted. Let's take the 2. Who is reading the 2 for us?
Okay, I will read.
Okay.
Question 2. On 1 September 2019, Black Limited purchased 19.2 million ordinary shares and 50 million preference shares in White Limited for 116 million and 30 million respectively. Below are the financial statements of the two entities. Please, should I read that or I should go to the footnote?
Okay, let's now solve it like the way, as if we are in the classroom, as
Okay.
if we are in the exam hall rather. Okay, so what do we do? If you see the question like this, what is the first thing that you have to do?
The requirement. We check the requirement.
The requirement is not even necessary because you know that it's statement of financial position. So you still prepare statement of financial position.
The group structure.
So the group structure cry is not even necessary. You put your statement over.
And just the additions.
Okay, so you start with the additions first. Okay. So can we all put the addition there? Can we all do the addition on our own?
Yes.
So as you are watching, you have this one. As you are watching, you have pen and paper. So look at the question over here. Put the additions together. Then we now solve the footnote together. Then you also be solving it yourself. Okay. So let's do that. So
the asset side is down.
okay. Or you can do it the way they put it. You can start with the equity first. You don't necessarily have to do with the asset first. You go according to how the statement is given to you. Please let's use some few minutes to put it down so that we can We can solve it together. I don't have to be the one solving it every day. So after this, the first is that you have to start with the group structure, isn't it? Okay.
Yes, please.
So let's go to the group structure. Okay. Let's start with the group structure. Okay. The group structure, can we determine the group structure from this question? Can we determine the group structure from this question? Can someone help us with the group structure? I'm getting 80%. What is the number of equity shares is the parent buying?
You are correct. 80%.
Okay. The parent is buying 19.2 million, isn't it?
Yes, please.
The question is, what is the number of what? Equity shares that the subsidiary is having? They are having 120 as a value and one share is 5 CD. So you can just find the number of shares. That will give you 24 million. Okay. So that will give you 24 million. So I can have my group structure now. So I can just have the subsidiary is what? Who is the black? Who is the parent? What is the name of the parent?
The black.
So White is the subsidiary. So I can put White Limited over here. Then I will have something like this. So I will have Black over here, Black Limited over here, which will be 9.2 divided by 24 million times 100. That will give us 80%. NCL over here will give us what, 20%. So you can write the acquisition date and also the reporting date and also the post-acquisition date. Okay. From this one, what will be the next thing that you have to do? The net asset of the subsidiary. You can see that the parent has purchased what? Preference shares in addition, isn't it?
Yes.
Someone might be asking why we didn't consider preference shares in the calculation of the percentage holding. Why?
Because they don't have a voting right.
Okay. Preference shares does not give ownership. We want to be part of the owners. So the only shares that can give us that kind of ownership is the ordinary shares. So if the parent acquire preference shares in excess, we have a special treatment for it. And we are going to look at it. It will be treated as what? As part payment of their preference shares. We'll get there. Okay. For that one, we'll get there. Okay. So the next one is that we look at the net assets. So let's look at the net assets at acquisition and also at reporting. Okay. So what is the first figure that will come here? What will be the first item that will come here?
Share capital.
Okay. The share capital is how much?
120,000.
Okay, 120,000, both acquisition and reporting. The next one is what?
Retain earnings.
Okay. Return earnings. The return earnings, what is the balance at acquisition? Were we giving?
21,000. Not for A. 62 million.
So we have it under footnote what? Okay, footnote A is 62 million. Okay. So 62 million. Okay. But reporting is how much?
91.
91.
What is the next item that will come? The same footnote A. What is there?
Other equity, other component of
Components of equity.
And that will give us how much?
2.5.
Okay,
2
2,500.
million.
Do they have any figure at reporting?
Oh,
Okay, what is the meaning of this? They have 2,500 at acquisition, but they are now having nil at reporting. What happened? What is the meaning of that? What happened? The meaning, the meaning is that during the post-acquisition period, the company has made a loss of what? 2,500 relating to other components of equity. Am I correct?
yeah.
Am I correct with that?
Yes, sir.
Okay. So it means that during the post-acquisition period, there was a loss relating to other components of equity that has canceled the balance at the date of acquisition. So if you are coming to the share of the profit, there is something that you are going to do over there. So if we get there, we will talk about it. Okay. So from this place, what do we do? What is the next thing that you have to look at?
The other foods that affect the subsidiary.
Okay. Or you can just go and open your goodwill calculation. You can open your goodwill calculation down because the question will always give you the purchase consideration. The question will always give you the purchase consideration. You can see that they have given us a purchase consideration here, isn't it? The amount that we are paying for the shares, they have given it to us. Okay. So you can count to and open this thing for the goodwill calculation. So you can open something for the goodwill calculation here. Then you look at the purchase consideration. The purchase consideration is for only the equity component, which is 116,000. Okay. So those of you that bring the investments also, those of you that you have the investment, which is the investment in white, those of you that you have the investment over here, what you do is that you now take 116 from it, and see which value you'll be having.
Have 30,000.
Okay, that 30,000 is the amount paid for the what? You can see that is the amount paid for the preference shares. Look at the top. They have also acquired 15 million preference shares in white for. So you can see that it's 160 and 30 million respectively. So the remaining 30 million is for the preference shares. We also come and look at that one later. Okay. Should we deal with the preference shares before we go to the other footnote? Yeah, Jocelyn.
Sir, please, from our earlier statement, we saw that the parents bought preference shares as well.
The parent did what?
The parents bought preference shares as well,
Preference
which is the
shares
116 million. Sorry, 50 million instead.
Preference shares does not give ownership. So the preference shares are debt holders of the company. Preference shares are creditors of the company. After you acquire the company is now your own. So the liabilities of the company will now become your responsibility. Is that the case? After you acquire a company, the liabilities of that particular company will now become your responsibility. Is that the case?
The asset and liability.
Okay, the assets and liabilities will now become your item now, isn't it?
Yes, sir.
Okay, so if you are buying your own liability, what is the meaning? What does it mean? Okay, let's take it from this side. Let's not think too much. Let's assume that you have inherited a business from your dad. Okay, if you inherit a business from your dad, you also have your own business, and your dad own will add to your own, and you have two now. Okay, now as soon as you inherited a business, the liabilities and the assets of your dad company will now become your own. Now you are saying that you are buying part of the preference shares in your dad company, which is directly your company. The meaning is that you are paying part of your what? Your preference shareholders off. You are paying part of your debt. You are paying part of what? Your debt. Because the preference shareholders are also preference shareholders of your company indirectly, because you are the owner of that particular company. So if you are paying them, or if you are buying back, it means that you are paying those people off. You are paying part of your debt. So that will be treated as payment of the debt, not an asset. So the company is paying part of their preference shareholders. They are buying part of their preference shareholders back. If you buy it, what will happen? We credit cash, we debit what? The preference shares. So what we do is the 30 million over there will also be removed. And we go and remove the 30,000 also from the preference shares of the company. That is the cancellation. The 30 million, we are just paying the people back. So that 30 million in the investment will be removed, because we can't have investment in our own company. We are paying the people back. We can't buy the preference shares in our own company. We are just using the money to pay them back. So we can't recognize an asset. So go and remove the asset, and your liabilities will also reduce by the 30 million. Go and also reduce the liability by 30 million. So the preference shares will reduce by 30 million. Subtract 30 million from the preference shares. You subtract 30 million from the investment. So the investment, all of them will go off. Yeah, I saw someone hands up. Sina, promise, your hand was up.
Yeah, sir. I wanted to ask if you are not going to do any adjustments with regard to the retained earnings.
Retained earnings for the reporting or at acquisition?
For the reporting.
For the reporting, they have given us the figures already. 91,000, but adjustment will come. But let's read the footnotes. You see, you just deal with the figures that you can get without doing any adjustment. So you can see that we have left the net asset open. You see that we have let it open. Okay. That if we are reading there's any adjustment, we come and adjust. But for now, we can't go and look for those adjustments and do it over here because time is not on our side. So you go and put those figures that you cannot suffer before getting. So you go and put them there. We have this one. Let's see whether we can get the NCA also from the figure. If you can't get it, then you now move on to the group retained earnings. Okay. The group retained earnings. What are we getting? What is the parents' retained earnings figure?
204.
204,000. Okay. So since you have these figures now, at least you don't have to suffer before you do anything. So you just now take the footnote one by one. I hope you have subtracted the 30,000 from the preference shares and also the investment.
Yes, please.
Okay. So that is the adjustment for that one. Okay. So let's now take the B. Let's take the B. Who is taking the B for us?
Okay, so there be the fair value exercise conducted on White Limited at acquisition disclosed that some inventory had their book value falling below their fair value by 4 million. 80% of these inventories have been sold by the year end.
Okay. So what are they saying over here? Is it increase or the adjustment? Is it increase or decrease?
Decrease.
Okay. So at acquisition, the value has decreased by what?
4 million.
4 million. So you go to your net asset at acquisition. So you have inventory of 4,000. Are we okay? So the value has decreased by 4,000. But was all the assets sold? The inventory.
No.
So okay, how many is remaining? What percentage is remaining?
Since 80% has been sold, so it means that 20% is remaining.
Okay, so the 20% of the 4,000, that will give us how much?
800.
So it means that we're supposed to come and take 800 also from what? From reporting. Are we okay with that? So it means that at reporting date, 800 of these goods are remaining. But this is a reduction. So you go and take the 800 from there. But has this particular thing been adjusted against your inventory? Has a fair value been adjusted against your inventory?
No, please.
So it means that the 800 is still included in the inventory. So we go and take the 800 from the portion of the inventory that is remaining. The inventory that has reduced is 4,000 at acquisition. But we were able to sell what? 4,000. We were able to sell 80% rather. So it means that the 20% of the inventory is still there, which is still carried at what? Their carrying value, but they are lower than their fair value by 800. So we have to go and take the fair value of the 800 from it to now reduce it. It was 4,000. Let me take it again. It was 4,000 at acquisition, but we were able to sell 80%. So we are able to sell the 80%. It means that those 80% has been removed from the inventory. But 20% of those inventory are still in the inventory at their carrying value. However, they are higher than their fair value by 800. So we have to go and reduce it to what? To their fair value by subtracting 800 from the inventory also. Okay. Jocelyn, I saw your hand up.
Yes, please. Sorry to take you back. I went off and I have returned and seen this. So please, I'd like you to go over it, please.
Oh, I've written a lot of things here, so I don't know which one you're talking about.
The inventory, sorry, the one under the net assets of the subsidiary.
Okay, read the footnote B. Can you read the footnote B from your phone, or I should show it to you?
Okay.
The fair
So please,
value
I'm
exercise
reading it
conducted.
from.
Okay,
Okay.
the fair value exercise conducted on White Limited at acquisition disclosed that some inventories had their book value falling below their fair value by 4 million. Some inventories had their book value falling below their fair value by. Are you sure this is a decrease?
Should rather be an increase.
It's an increase.
It's an increase. Some inventories had their book value falling below their fair value by what? 4 million. It means that the fair value is higher than what? The book value. So it's not a reduction. So read it again. Okay. Some inventories had their book value falling below their fair value by what? $4 million. So this is an increase, not a reduction. Okay. So that will be an increase, not a reduction. So we have 4,000 over here, but reporting will be what? 800. Because they have sold 80%, remaining what? 20%. So the 20% of the 4,000 is the inventory remaining at the reporting date. So that will be 800. Auntie Joyce, are you okay with that?
Yes, please. Thank you.
This 800 will be added to what? To the inventory, because the fair value adjustment has not been what? Taken into consideration. So sorry, it's not upward revaluation. It's not a downward revaluation, rather it is an upward revaluation. So you go and add the 800 to your inventory. So do that. Add the 800 to the inventory. So it's not a downward revision, but it's an upward revision. You have to look at it very well. So has their book value falling below. The book value is falling below the fair value. So the book value is below. Maybe they say the book value is above the fair value by 4 million. It means that the fair value is lower than the book value. Okay. So I hope we have done the adjustment for that. 800 added to the inventory, and let's move on. Okay. At acquisition, someone should take the C.
At acquisition, 2 restructuring plans relating to White Limited were considered. Number 1, the first plan related to reorganization of one of its major plants. As at acquisition date, the agreed plan was yet to be communicated to relevant employees, but immediately meeting was held with all affected workers. Then the reorganization followed and was completed within 2 months. Closure costs amounting to 2 million were duly provided for. Final settlement has been made, but White Limited has not yet recorded the payment.
Okay. So what is happening here? What standard is that?
IAS 37.
Okay.
Provision.
And it's talking about what? Restructuring, isn't it? It's talking about restructuring, isn't it?
Yes, please.
Okay. When do we, if you are doing restructuring, when do we make provision?
We make
When
provisions
Okay.
when there is meeting, the plan is effectively communicated to all affected people.
Okay. Or the people they have started implementing the plan. Sometimes it cannot be communicated, but there will be a formal plan, but they will not communicate it, but they will start operating it immediately, or they will start operating it. In that case, you can still make provision for the cost relating to that particular amount. But the first plan, Was the plan communicated to the people?
No, please.
Okay, so it means that at acquisition, there shouldn't be any provision, isn't it?
Yes.
Yeah, there should not be any provision.
Okay. But they said that immediately meeting was held with all affected workers. Then reorganization followed and was completed within 2 months. Closure costs amounting to 2 million were duly provided for. Final settlement has been made, but White Limited has not yet recorded their payment. So the immediately that they are talking about will be after acquisition. So no plan was in place at acquisition day. So we don't have to make any provision. It will be after the provision before the plan will be what? Will be effected. But what happened? They have incurred a cost of what? 2 million, isn't it?
Yes, please.
And this has been duly provided for. It means that a provision has been charged to profit or loss. And they have also they also include 2 million in their current liabilities. They say the payments have been made, but it is yet to be what? Recorded. How do we deal with this particular transaction? How do you deal with the payment? How the payment, what will be the double entry for this particular payment? Please, can you hear me? What will be the double entry?
We'll debit the P or L with 2 million, then credit our current liabilities with 2 million.
No, they say that this has been duly provided for. It means that they have done that entry already.
So you have to reverse it.
No, it's supposed to be done. Provision is supposed to be done. But what they are here to do is the final settlement. Final settlement has been made, but White Limited has not yet recorded the payment. So what we are going to do is the recording of the payment. That's what we are going to do. All the necessary things have been done already.
So you debit bank.
No, we are paying.
We are going to reduce the net assets.
No.
So we add it to current liabilities.
We debit current liabilities.
And then we debit our group retains and
no, please. Hey.
We credit bank.
We credit bank and debit the current liabilities. Read the question again. Then the reorganization followed and was completed within 2 months. Closure costs amounting to 2 million were duly provided for. It means that they have made a provision for this particular transaction already. They sent 2 million to what? To profit or loss as a provision, and they have the 2 million in the current liabilities as provision. So the correct entry has been done. What they are here to do is to what? Is to record the payment. That's what we are coming to do. So we reduce our current asset or the bank, then we also reduce our liabilities. So you go to the bank if you have bank in the question. Okay, we have other current assets. You take your 2,000 from it. You go to your current liabilities or other current liabilities. You also take the 2,000 from it to now record what? The transaction. I hope we have done that.
Yes, please.
Okay. Let's take the second reorganization.
The second plan involved a closure of a unit. White Limited has discussed the agreed plan with various stakeholders. The closure costs were estimated at 3.5 million, including relocation cost of 1 million at asset acquisition. The closure was duly effected 3 months after White Limited's acquisition. White Limited has correctly recorded the final settlement.
Okay. So this one, what do we do? Do you have to make a provision at the date of acquisition? Should there be a provision at the date of acquisition?
Yes, please.
And at what amount?
2.5 million, 2,500.
Why 2.5, not 3.5?
You taught us that when we are estimating for the cost of provision, the fair value of the provision, we do not add the relocation cost to it.
Okay, 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 okay. That's nice. The provision only cover the costs that are necessary for the what for the restructuring. The relocation can be you are moving some of the staff from the old place to the new place. Even if the company is not closing down, they can still do transfer of what of the staff. So the costs that are associated with the continual operation of the company are not provided for. And relocation is also part of what activity or is part of the cost that is relating to the continuous activity of the company. So relocation, transfer of staff, the cost, all those costs are not included in the provision. We only make provision for the redundancy cost. Maybe you have to pay some people off, and also maybe there's a penalty that you are paying as a result of you canceling a lease liability relating to the reorganization or something like that. So we only recognize the 2,500 as a provision. Will it be addition or it will be a reduction? So the provision over here, this will be done at acquisition. Provision is a liability, so it will be a reduction, isn't it? Okay. It will be a reduction. What are they saying there? They are saying that the closure was duly affected. The closure was duly affected 3 months after White Limited acquisition. White Limited has correctly recorded the final settlement. It means that they have done everything. Everything that is relating to the post-acquisition has been done. They have recorded the transaction, but just that the provision was not made at the date of acquisition. So there will not be any provision at reporting because they have paid and they have recorded that particular transaction already. So the only item that we bring over here is the acquisition figure. So this will be dash. This will be dash because this has already been done already. So the only figure that we bring is the acquisition figure. We should make provision at the date of what acquisition because the plan was communicated to what to the people who are involved. Let's look at the D. So for this particular one, the only entry that you are going to be doing is to bring the 2,500 to net asset at acquisition. The payment has been duly done and the final settlement has been done. So it means that they have provided for it, they have paid for it, and there's nothing in
Yeah,
the
right. We are paid. No.
Okay. Okay. So let's look at the D.
Okay, so the D.
Yeah.
White Limited's intangible assets represents a deferred development expenditure. At acquisition, it was established that the related project was no longer expected to produce future inflows, and hence the capitalized expenditure should be fully written off. Cumulative charges relating to these intangible assets since White Limited's acquisition have amounted to 5 million.
Okay. So what are they saying? They're saying that the intangible asset represents what? A deferred development expenditure. At acquisition, it was established that the related project was no longer expected to produce what? Future inflows, and hence the capitalized expenditure should be written off. So when are they saying that we should write this particular thing off?
At acquisition.
Okay. So let's go to the statement of financial position. What is the value that we have relating to the intangibles?
45,000.
Okay, this 45,000 is at what? Reporting or acquisition?
Reporting.
Okay.
Reporting.
That is very nice. That is very nice. They are saying that the cumulative charges relating to these intangible assets since White Limited acquisition have amounted to 5 million. The charges that they are talking about, they are saying that from the date of acquisition to the reporting date, they have charged what? Amortization of what? Or they have amortized the development expenditure by 5 million. The meaning is that, or the question now is, what should have been the value of the development expenditure at acquisition?
50 million.
That would be 50 million, isn't it?
Yes, please.
Yes. So that would be 50 million. So we have 50 million at acquisition and we have amortized it 5 million. That is why we have 45 million over there. So you count to the intangibles over here. Your at acquisition will be 50 million, which will be 50,000. But reporting will be what? 45,000. Are we okay? They are saying that we should write it off. It means that it will be written off. It is going to reducing the net assets. So what do we do? In the statement of financial position, we are going to be removing the 45,000. So go and subtract the 45,000 from the intangibles because they say you should write it off. So the 45,000 will no longer be there. All right. It is very important.
Please come again.
Okay. They are saying that the development is the intangible over there represents a development expenditure, isn't it? Which at acquisition, they are saying that it should be written off fully at acquisition. So the question is, we have to know the value of the intangible asset at acquisition, but we know reporting figure, isn't it? To be 45,000. But they are saying that from the date of acquisition to the date of reporting, they have charged amortization expense of 5 million or 5,000 on the development expenditure. So the question now is, what should have been the value of the development expenditure at acquisition? It should have been the value at reporting plus the what? The amortization charge during that particular period. So it means that we have 50 million over there because before we charge the amortization on it of 5 million to reduce it to what? To the 45 million. Or another way of going about it is that how do we calculate carrying value? Carrying value is calculated as what? Cost minus what? Accumulated what? Depreciation or amortization. Isn't it?
Yes.
Okay. The carrying value in the books is 45,000. Is that the case?
Yes, please.
Okay. The cost, do we know the cost?
No, please.
But we know that the accumulated amortization for the year is what? 5,000. How do we find the cost now? 45,000 plus 5,000 will give us the cost. And that will give us 50,000. I hope you're okay with the 50,000 now.
Yes, sir.
Yeah, I'm okay with the 50,000.
Okay. So at acquisition, we will come and remove the 50,000 because they say it should be written off. But at reporting, you can see that 45,000 is also part of the net assets. So we go and remove the 45,000 also over there. If you go to the statement of financial position, you see that you still have intangibles in the consolidation, isn't it?
Yes.
But they say that the intangibles should be written off. It means that you should have zero for the intangibles. So you go there and subtract the 45,000 from it.
Okay.
All right.
Thank you.
Okay, you're welcome. Let's go to the next one. It's a very simple question, but it's not that simple. Okay. It's a very simple one, but it's not that simple. But what is that the case? It is wrong. Let's look at the E.
All right. So with the E,
Yeah.
reconciliation between the two current accounts revealed that there was a delayed receipt of one invoice issued on 29 November by White Limited for some goods dispatched to Black Limited. White Limited transferred the goods at a margin of 33 whole number 1/3%.
Okay, so right now, who is selling to who? Who is selling? Is it the parent or the subsidiary?
The subsidiary.
The subsidiary.
Okay. Okay. Let's now come here. Let's go to the current accounts. What are the current accounts that they have? What's the current account balance for White Limited? White Limited. What is the current account balance under White Limited?
15,000.
No.
No,
84,000.
18.
It's
18,000.
18,000, isn't it?
Yes, please.
Okay. But what is the current account balance for Black?
That's 15,000.
Okay. White is saying that Black is owing them how much? 18,000, isn't it?
Yes.
Yes.
Okay. And Black is saying that they are owing White how much? 15,000.
15,000.
What is the difference?
3,000.
Okay. That 3,000 is relating to the what? The goods that they are talking about. Are we okay?
Okay.
Okay. So that 3,000 is relating to the goods that we are talking about. Okay. We have so many ways of going about this one. You can assume that the sales was not made. So the sales has not been made. Then you just adjust it. Or you assume that the parent has received the goods. The parent has actually received the goods before you cancel again. Okay. Whatever be the case, you have to remove the current account balance. What do? Go to your current account, subtract the 18,000 from the asset. Under the current asset, go and remove the 18,000 there. And go and remove the 15,000 also from the current liabilities also over there. Then we now work for what? The 3,000 now. Have we done that?
Yes.
So
Okay.
you have to remove it by subtracting the same 18,000.
You subtract the value you have over there. 15, you subtract 15 from 15, 18 from 18. You see that you have subtracted 2,000, 3,000 in excess, isn't it?
Yes.
Okay.
I'm not getting it.
Okay. In the current account of the subsidiary, it is 18,000, isn't it?
Yes, please.
Remove all the 18,000.
Okay.
Okay. Come to the current account of the parents. It's
Current
15,000.
liability.
Yes. Current liabilities. Current account of the parent is 15,000, isn't it?
Yes, please.
Subtract the 15,000.
Okay.
You can see that you have reduced the assets 3,000 more than the liability, isn't it?
Yes, please.
Okay. We are going to work for that 3,000 now. Okay.
Okay.
They say that the goods are what? What is the value of the goods? What is the selling price of the goods? It's 3,000, isn't it?
Yes.
Okay. But they are saying that these goods are sold at what? Are we giving margin?
Margin.
Are we giving a margin?
Margin.
Okay. At a margin of 33 whole number, 1/3%.
1/3%.
If you change that one to fraction, what are you going to be getting?
1/3.
You'll be getting 1/3. Okay. You'll be getting 1/3. So the 3,000, is it a selling price or cost price?
Selling price.
Okay. Because white is the one selling, so white will always sell at a selling price. Okay. So let's now look at the profit on the goods. So let's now look at the profit on the goods. That will be 1/3 times what? 3,000. Are we okay?
Yes.
Okay.
That'll be 1,000.
That will be 1,000, isn't it?
Why is it 1/3?
Oh, it's if you change 33 whole number, it will be 100/3%, isn't it?
Yes.
Okay. And this 100/3 can also be written as 100/3 divided by 100. Percentage is over 100.
Yes.
You know that it can be written like that, isn't it? Okay. We can't divide, so we have to do what? We have to reciprocate this particular fraction, 1/100. So this will now be 100 over what? 300. Okay. Which is 1/3. I hope you're okay now. Okay.
Yes. Okay.
So it's plenty mathematics that they are doing in the to get this one. It's not easy as you add or you subtract. No, you have to do it very well before you add or subtract. Okay, so that would be 1,000, isn't it? Okay. The goods has not been received by what? The goods has not been received by Black Limited, isn't it?
Yes.
The goods are still in transit. So since the goods are still in transit, we still assume that the goods are still with the parents. The goods are still with the subsidiary rather. Okay, the goods are in transit. If the goods are in transit, the assumption is that the goods has not been sold in the first place because the people have not received the goods. So it means that the goods are still with us, which will be recorded at what? 2,000. So you go and add 2,000 to the inventory, assuming that the goods has not been sold. The goods has not been what? Sold. Because the goods has not been received. The goods has not been sold. So the inventory should still be with you. So you go and add the 2,000 to the inventory or the other current assets. Okay. What happens to the thousand over here? The time that the subsidiary is dispatching the goods, they have recognized a revenue of what? Of 3,000. And they have recognized a cost of sales of 2,000. It means that there's a profit of 1,000. But the goods has not been sold. You can't recognize this profit of the 1,000. So what do? You go to your net assets and now have provision for unrealized profits of 1,000 at reporting. So you have adjusted for the 1,000 now. You have reduced your equity portion by 1,000 and you have added what? The 2,000 to it. So that is all. It means that the liability portion, you are reducing the liability portion by 16,000. The 15,000 plus the 1,000 unrealized profits. But if you come to the asset side, you are reducing what? 16,000. Why 16,000? 18,000 and you are adding back what? 2,000. That is the first way of looking at it. You assume that the goods are still with the what? With the one selling. So if the goods are still with them, it means that the goods has to be in their inventory at cost. So you go and add the 2,000. They have a profit element on the goods which has not been realized. Go and take it from the what? Their retained earnings. That is one way of going about it. Let's look at the second way of looking at it. The second one is that you assume that the parent has received the goods. Okay, you assume that the parent has received the goods. If the parent has received the goods, what are they going to be doing? They will debit their inventory of what? 3,000. Am I correct?
Yes,
If the
sir.
parents have received their goods, they will debit their inventory of 3,000, which is technically purchases. Okay. And they will credit their current accounts because they haven't paid of what? 3,000. Are we okay? Are we okay with this one? You assume that
Yeah.
the parents has received their goods. If they have received their goods, this is the entries that they are going to be doing. So you can go and add 3,000 to your inventory and also add 3,000 to your what? To your current account under the current liabilities. You'll see that it will now be 18 against 18. If you look at it like that, is it going to be 18 against 18? The current account
Yes.
on the parent is, so it will be 15,000 plus 3,000.
Plus 3,000.
Okay, and the current account will be what? Will be 18,000 for the subsidiary. So it's now 18. You can go ahead to subtract the 18 from all of them. Okay. But the inventory over here is included at what? At selling price. The goods has not been sold. So the profit element on it should not be realized. So what do? You now calculate unrealized profit over here, multiply by 3,000. That will be 1,000. So this 1,000, you send it to the net asset of the subsidiary, and you also take it away from the inventory. So you see that at the end of the day, you are still adding 2,000 to the inventory. So you can do it in so many ways. The first one is that the goods has not been sold. The second one, okay, the goods has been sold and the goods has been received by the parents. If the goods has been received by the parent, what are they going to be doing? You do their entry. You add the 3,000 to inventory. You add the 3,000 to their current account, which is a liability. Then you now go ahead to remove your current liability, the current account, 18,000. The goods are recognized at what? Selling price. But the goods should be at selling price, lower of the selling price or the cost price. The cost price is 2,000. Selling price is what? Is 3,000. So you have to go and remove 1,000 over here and also send this 1,000 as a deduction to net asset at reporting because the profit element is there. That's all. Very simple. Please, I don't know why I'm asking you to write the figures yourself. I don't know. I just decided to ask you to. I don't know. I don't know. So whatever we are doing, take it seriously. I don't know. I don't know why I'm asking you to do it. Maybe it might be the Holy Spirit that wants to do something. I don't know. So try to take it seriously. Understand adjustment. If you don't understand, this is the time that you have to ask questions. Ask me, I will tell you. All right. Okay. So that is the E part now. Let's come to F.
The F.
Okay.
Black Limited acquired 25% equity interest in Yellow Limited on 1st June 2020. Black Limited settled the consideration by issuing 7 million of its own shares to the previous shareholders of Yellow Limited. The share price of Black Limited and Yellow Limited at 1st June 2020 were estimated at 2.5 Ghana cedis and 3 Ghana cedis respectively. Black Limited has not yet recorded the above transaction.
Okay, let's look at that one first. So you can see that Black is what? Black is making an investment in associates, isn't it?
Yes.
Okay.
Yes.
How are they settling this particular transaction? What method of payment?
Share issue.
Okay. So what will be the value of the shares that they are going to be issuing?
To be the 25% times the 7 million times the 2.5.
No, please. They are issuing the 7 million for the 25%.
Yes.
7 million times 2.5.
Exactly. That is the value of the shares. We are giving you 7 million at 250 pesos for the 25%. What is the value of the shares we are giving to you right now? That will be, so let me count to investment in associates. Okay. So that the person who said the 25% times 7 million, no. The 7 million is not the total shares. We are giving you the 7 million for the 25%. That is it. So we are acquiring 25% of your shares and we are giving you 7 million shares in return. So your investment in associates, your investment in associates will now be done as, okay. So we look at the fair value of this particular figure, which will be 7 times 2.5. What are we getting?
17.5.
Okay, 17,500, isn't it?
Yes, sir.
What will be the corresponding entry for this particular transaction? If we are paying cash, we are going to credit cash, isn't it?
Yes, sir.
But right now, we are not paying cash. We are giving shares. So what item are we going to be crediting?
We are going to
We are going to
reduce the value of our ordinary shares.
no, please. Don't assume that. Don't assume. Even if you are reducing the value of your ordinary shares, it means that you are debiting, isn't it? If you are reducing the value of the ordinary shares, it means that you are debiting, isn't it?
Yes, sir.
Okay. But the investment, are we debiting the investment or we are crediting?
We are crediting.
No.
We
Investment,
are debiting.
we are debiting the investment. So the corresponding entry should be a credit. It is equity, but it's not debiting. Okay. Let's look at it like this. Okay. We are buying what? 7 million. We are buying 25% shares. But what we have to do is that we have to issue 7 million shares before we pay for the 25%. You can also look at it from this perspective. You first assume that the company has issued a new shares to settle the consideration. The new shares that we are going to be issuing will be 7 million, isn't it? We issue the new shares at 7 million, which will go for 2.5. So we issue the shares to settle the consideration. So what we do is that if we issue the shares, we are going to be having debiting cash or bank with 17,500. If we issue new shares, what will be the position? You have cash and your shares will increase, isn't it? Is that the case? If a company issues new shares, they will receive cash, and the shares will also increase. The double entry will be debit cash and credit what? The shares. Please, are we here?
Yes.
Okay. So you credit the equity shares with how much? 17,500, isn't it?
Yes.
That will be the first entry. You issue shares to settle the consideration. So you assume that the company has sold the share to a third party, and they are now using the proceeds to buy the 25%. So if they issue the shares to a third party, they will be receiving a cash of this, and their shares will be increasing by 17,500. What are they going to do? They will now use the cash of 17,500 to buy the investment. So you will now go and use the cash. So you debit your investment of 17,500. Then you now credit your what? Your cash of 17,500. Okay. What is happening here? You can see that the equity is increasing. Cash is what? Increasing at the same time reducing. So you can see that the cash is having a zero what? Effect. Cash is having a zero effect. That is why when there is a share exchange, we only go straight forward to the net effect, which will be debit investment and credit the equity shares. So you'll be adding 17,500 to the equity share, not subtracting. You will be adding because it will be increasing. It's not as if you are selling your existing shares to pay for them. No, the existing shares will still be there, and you are having additional shareholders. You are having additional shareholders. So it's not that you are selling the existing shares to pay. No, you are issuing a new shares to them. So you add the 17,500 to what? To your equity. Are we okay with that? Or you have any concern? Okay.
Okay.
It's very interesting, but don't worry, we are very fun. So you open the investment in associates, you have the fair value of 17,500. Then you now add 17,500 to your what? To your equity. I hope we have done that. Okay. Let's now take the remaining issues there.
Black Limited acquired 25% equity interest in Yellow Limited on 1st June 2020. Black Limited settled the consideration by issuing 7 million of its own shares to the previous shareholders of Yellow Limited. Oh, this one we've done. Yellow Limited, yeah. Okay. Yellow Limited reported a net loss after tax of 1.8 million for the year ended 30th November 2020. Yellow Limited half-year interim report for the period ending 31st May 2020, however, showed a net profit after tax of 0.2 million.
Okay, so you can see that this particular one is relating to the first thing that we have done, isn't it?
Yes.
So what will be the profit during the post-acquisition period? What will be the post-acquisition profit based on the first principle that we used?
Yes, I'm coming.
So 1.6.
No, 2 million.
For the year is the 1.8 is a loss. Oh.
Yeah, 1.8 is a loss.
Okay.
And they made a profit of 0.2. That means in the year they made 2 million profit. When you take the loss of 1.8, you get the profit of 0.2 million.
Okay, it means that during the year they made a loss of 2 million.
No, during the year they made a profit of 2 million, but they
made also 2 million.
Yeah, the 1.8 is a loss.
Yes.
Okay, so the 1.8 is a loss. But at the beginning, before we acquired them, you can see that they were acquired on what? On 1st June, isn't it?
Yes.
Okay. They are acquired on 1st June, and Yellow Limited reported a net loss after tax of what? 1.8 for the year. That is a loss for the year ended 30th November 2020. Okay. We acquired them on 1st June from 1st June to November is 6 months. So they are saying that the half year interim what accounts for the period ending 31 May 2020. That means the period before we acquired them. Okay, they made a profit of 0.2. But after the year end, the total loss made for the year, which is the 12 months, is now 1.8. So the question now is, we first have a profit of 0.2. Now at the end of the year for the 12 months, we now have a loss of 1.8. What happened during the last 6 months? That is the question now. So what will happen during the last 6 months? They made a loss of what?
2 million.
2 million. It's not profit, it's a loss.
Okay.
Okay. If the 1.8 if the 1.8 should be a profit, then it means that the profit during the post-acquisition period will be 1.6, because our total profit is what? Is 1.8. They made 0.2 before we acquired them. It means that we have made 1.6. To put the two together now to have what? To have 1.8. But this is a loss. This is a loss for the year. It means that during the post-acquisition period or after acquisition, they made a loss of 2 million, which now reduce the 0.2 profit. Then we have a net loss now of 1.8. So the post-acquisition loss, which is 6 months, will now be adjusted against our investment in associates. So we count to the share of we didn't say anything to the retained earnings, or nothing happened to the retained earnings yet. Okay, so share of post-acquisition loss. So share of post-acquisition loss, that will be 0.25 multiplied by 2 million. What are we having?
Zero 0.25 times 2. That will give you 0.5.
Okay, so that 0.5 will be 500, isn't it? Or 50?
500.
Okay, so that will be a loss of 500. This loss will go where?
Group retained earnings.
Okay, so the parent will take its loss to group retained earnings. So that will be 500. I hope we have done this adjustment. Okay. Let's now go to any other issues that they are talking about over here. Hey, so nothing has happened to the group retained earnings at the beginning of tonight. Okay. Okay. So let's come to the G.
Okay. Included in the inventories of Yellow Limited are 1.2 million worth of goods bought from Black Limited. The goods had cost Black Limited 0.4 million more than the transfer price. These inventories were in good condition and highly marketable at the date of sale.
Okay. They are saying that the included in the inventories of Yellow Limited are what? 1.2 million worth of goods bought from Black Limited. The goods had cost Black Limited 0.4 million more than the transfer price. It means that the cost price of the inventory is what? What will be the cost price?
That will be 1.6.
Okay. The cost price will be 1.6. Okay. So they are selling at a loss of 400, isn't it?
Yes.
Okay. They are saying that these goods were in good condition and highly marketable at the date of sale. You can say the parent is now impairing the goods. The loss on the goods is still seen as what? Impairment of the inventory. But they are saying that these goods are in a good condition and they are highly marketable at the date of sale. It means that the goods can still be sold. Nothing has happened to the goods. They're in a good condition and they are highly marketable at the date of sale. The meaning is that there is no indicator for impairment. The goods has not impaired. But the people are now paying 1.2 and you are giving them 1.6. No, that should not be the case. Since the goods are in a good condition and they are highly marketable, you should not sell to them at a price lower than what? The cost price. We only carry the impairment loss on an item when there is an indication or when there is an indicator for an impairment. They are saying the goods are in a marketable condition and they're in a good condition. If you have tomatoes over there, the only time that you can sell the tomatoes to me at a price lower than the price that you bought it is where the tomatoes is getting what? Is getting.
Hello, sir.
Yes, please.
Please, I have problem with my network small, so I went off. So if you can go over from F.
Oh, don't worry, the recording will be there for you. The meeting is recorded. Okay. Okay. So what we are saying over here is that you have tomatoes that you bought for 10 cedi. Before you can sell the tomatoes to me at 8 cedi, that it's because the tomatoes is getting spoiled or something has happened to the tomatoes that you can't sell it at the cost price again. Maybe the tomatoes is in a good condition and nothing has happened to it. The least price that you can sell it to me at is at cost. The least price that you can give it to me is at cost. Now you are giving the tomatoes to me at 1.2 instead of 1.6, but the tomatoes are still in a good condition. The assumption is that a portion of the tomatoes that you have sold to the people is actually 1.2. So the remaining 1.4 is still in the inventory. So if the goods are still in a condition, they should not be impaired. So you have to reverse the impairment, So the loss over here, who is selling is the parents, isn't it?
Yes.
Okay. The time that the parent is selling, the parent has taken the 400 from their group return earnings, isn't it?
Yes.
Okay. And they have taken 1.6 from their inventory. In actual sense, they should take 1.2. So what is going to happen is that we reverse the impairment by taking the 400 to what? To group return earnings as the reversal of the impairment. So you reverse the impairment of 400. Then you go and add 400 to the inventory because you should have taken 1.2 from the inventory, not 1.6. So you go and add the 400 back to now reduce that particular net effect. So if there's a sale of inventory at a loss, and the question says that the inventory is in a good condition and highly marketable, it means that the inventory should not actually be impaired, and they should be carried at cost. So go and reverse any loss or any impairment loss on the inventory. How do you reverse that? You go and add it back to the return earnings of whoever sold the inventory. But whoever is selling the inventory, you add the impairment back to the inventory. That's all. That is about that particular one. So you add to the inventory, you add to the group return earnings of the parents. Let's look at the last one. Then we know what we are doing.
Okay. At year end, no impairment was required on goodwill in White Limited. However, due to the reported losses, investment in Yellow Limited was attributed with impairment loss of 0.25 million.
Okay. So the impairment in Yellow Limited has the investment in Yellow Limited has impaired. So you just bring impairment over here. It means that the investment has been impaired by 250. This impairment will be taken by the parent, 250. So it means that the investment has suffered an impairment of 250. Don't say you are going to be taking 25% of the 250. No, it is not the entire company that is impairing. It is just the investment that you are making over there. That is impairing, not the entire investment that the Yellow Limited is having. It's only your own that is impairing by 250. So it will affect only your 250. Let's look at the last one. Then you can now put your figures together.
It is the policy of Black Limited Group to measure NCI using the proportion of net asset method.
Okay, let's now put the net asset together at acquisition. What will be the total? We're having 136. Can someone confirm the 136,000?
Confirmed. 136.
Okay, let's come to report.
Yes, sir. One.
$165,800.
Okay, 165,800. Okay, so let's use this to calculate our NCI. The NCI will be 0.2 times what? 136,000. Am I correct? Is that 20% correct?
Yes, please.
Okay. So what will be the NCI at that date? 27,200, isn't it? Okay. Can we now find our goodwill? So the goodwill will be 0.8 times 136,000. Then we subtract from the purchase consideration. I'm having 10,800. $7,200. Goodwill 7,200. Is it confirmed?
Yes, sir.
Okay. Then you send your goodwill to
Confirm.
statement of financial position. The investments in associates, you have to also total it and send it to your statement of financial position and the non-current assets. Then let's now count to the net asset. What is the difference?
$29,800.
29,800. Okay. I'm going to tell you something about this 29,800. Okay. We mostly, you look at the profit component of this and you also look at the revaluation surplus component of this particular figure. Okay. You can see that during the post-acquisition period, there was what? A loss of 2,500 relating to what? Other components of equity, isn't it?
Yes, sir.
Okay. And this has now reduced our what? Our post-acquisition profit figure. Okay. So what you do is that you make your post-acquisition profit. You are going to be making your post-acquisition profit of 29,800 plus 2,500. Then you have your actual post-acquisition profit that is relating to retained earnings will be 29,800 plus 2,500. Then you have other components of equity loss of 2,500. So this is how we got the figure. The actual figure was 32,300 for the post-acquisition profit, but we have subtracted 2,500 from it, which is the loss made through that particular year. You can go ahead and share the 29,800. But what will happen is that your retained earnings figure will be wrong. However, the NCA will still be the same. The NCA will still be the same. So what you do is you will share post-acquisition profit of 32,300, which is the actual profit made. Then you will now share the loss of other components of equity of 2,500. So that is how you are going to share it. The parent to, so the NCI, the share of post-acquisition profit. The NCI, you can just do 0.2 times the 29,800 for them because they will have the share of the profit the same time the share of the loss. But the parent group retained earnings, you have the share of post-acquisition profit, which will be 0.8 times 32,300. Then you go to their group, you go to their component of equity, other components of equity, and have 0.8 times 2,500, which will be a loss. So you take it from their other components of equity, 0.8 times 2,500. That is 2,000. So you subtract in the other component of equity section, in the equity section, take 2,000 from it as the share of the loss. If you count to group retained earnings, this is what you'll be having. 0.8 times 32,300. I'm having 25840. Okay, so you can now put the figures together and move on. So goodwill will be 7,200, 0.2 times 29,800. So NCL will be having 5,960 plus 2,7,200. NCL is 33,160. Okay, you send the NCL over there as that figure. The goodwill has not impaired, so 7,200 will go. The group retained earnings, you total it. So you have 204,000 plus 400 plus 25,840 minus 750. I'm having 229490. So you send this one to the group retained earnings as the workings. If you count to this place, you have 17,500 minus 750. I'm having 16,750. That will be the investment in associates. So you can now add all your figures together to move on. Okay.
But please, I want to see the investment in associates.
Linus,
Yes, please.
what if in the exams I don't do the totals?
Nobody's going to penalize you. But you
Okay.
lose ticks for them.
Okay.
But don't try to balance, because the balancing figure will not give you any tick.
Okay.
But the posting will give you ticks. Okay. I don't know why I've asked you to do this thing yourself. Okay. So those who want to balance can put them together and total. Okay. I don't know why I'm asking you to do it yourself. Anything is possible. And that is it.
Right. Linus,
Yes, please.
the way you share the post-acquisition profit, like I wanted you to explain it more again a little.
Okay. Okay. All right. You see, in actual sense, we have other components of equity of 2,500, isn't it? At acquisition, but at reporting is now 0. It means that
Yes.
during the year there is a loss of 2,500. Okay, there is a loss of 2,500. Okay, but this particular loss has been adjusted against our net asset. You can see that this is increasing the net asset at acquisition by 2,500 more than this one. So in actual sense, you can put the 2,500 over here so that you know only the post-acquisition profit. You see that you'll be getting the 32,500. So the actual profit for the year should have been 32,500, but we have subtracted the 2,500, which is relating to other components of equity. It's not part of the normal trading activities. It can be revaluation surplus or revaluation loss. There was a revaluation loss that has canceled the previous revaluation gain. That will not be taken to retained earnings. It will be taken to revaluation reserve or other components of equity. But we are now adjusting the loss against our profits. So the profit should not be 29,800. This profit is net of what? The revaluation loss of 2,500. So the question is, what should have been the actual profit for the year. We add the revaluation gain or the loss to the net figure. Then we treat this particular figure like this. So it will be 32,300. Subtract 2,500 from it. That will give you 29,800. But we don't want to do it like share this net amount. We want to share the profit separately and also the other components of equity separately. So you have to separate it and share according to how it's supposed to be shared. It's somehow complicated and somehow confusing. But if there should not be any loss during the year, the reporting should also be 2,500. And if you calculate, your post-acquisition profit will be 32,300. You can check and see. So
Okay.
if you assume that there is no loss during the post-acquisition period, your post-acquisition profit will be 3,200.
Okay.
Have you got it?
Understand.
Okay.
Yes, sir.
Now the loss has reduced it to 29,800. So share the loss separately, share the profit also separately. That's how you go about it. All right. Let's see whether we can pick some questions on interpretation. Then we go and do our own thing. Statement of profit or loss is not likely. So you have to. So the interpretation, as I indicated earlier, interpretation, we have basically two tools, which is a ratio analysis and also the common size statements. Okay, the common size statements, we can have a vertical one and a horizontal one. You have been doing the vertical one in public sector. The common size that you have been doing is the vertical one. The vertical, what we do is that we take a figure as the base. Mostly for profit or loss, we use revenue as the base. Okay, then we use the other items to write as a proportion of the base. So if you want to know the percentage of the revenue that is being covered by cost of sales, we have the cost of sales figure divided by the revenue, then multiply by 100. That's how we do the vertical. This is vertical. But if you count to horizontal, we find changes in each items. So if you have revenue for 2020, 2019, 2018, the question is, what is the change what is the growth? We find the growth. So this will be 1,500. This was 1,000, and this was 750. So we find the growth each year. That is what we call the common size. So the horizontal common size, we find the growth in an item for every year. So from 2018 to 2019, the revenue has grown by what percentage? From 2019 to 2020, it has grown by what percentage? How do we do that? We have the 1,500 minus the 1,000 divided by the original figure. So the difference over the original figure times 100. That's the growth from this date to this date. That is the horizontal. But for public sector, you have been using the vertical common size, where you use one as a base and try to express the other items as a percentage of the base. In the statement of profit or loss, we use revenue as the base. The statement of financial position, we use the net asset as the base. Or we use the total asset as the base. Okay. The ratio analysis is just the formulas that you'll be using. Okay. And this ratio analysis has been divided into 5. We have the profitability ratios, we have the liquidity ratio or the solvency ratios, we have the working capital management ratios, we have the gearing ratios, and we also have the investment ratios. The question will always be about either profitability or the liquidity ratios and part of the gearing ratios. If the question will direct, they will not ask you the ratio to calculate. One way of the examiner assessing the student is that they will not ask the student calculate this ratio. They will not ask you that. They will just say write a report analyzing the financial performance and financial position of the company. You have to now ask yourself, what are the ratios that I can use to analyze a performance of a company? Those ratios will always be the profitability ratios. So if they ask you to analyze the performance of if they ask you to analyze the performance of the company, then you use the what? Profitability ratios. So you use the profitability ratios. So these profitability ratios, you have your gross profit margin. You have the gross profit margin. You have the gross profit margin. You have the net profit margin. You have the return on capital employed, and sometimes you have the return on equity. Okay, so these are basically the ratios that you'll be using to analyze the financial performance. They are ratios that is talking about how good or bad the company is performing. So the question can ask you directly that analyze the financial performance. You should focus more on profitability ratios for the what? For the financial performance. And they also ask you to for financial position. The financial position, you look at what? Financial statement, what ratios. The first one will be the liquidity ratios. You look at the liquidity ratios, which is the current ratio, and then the what? The quick ratio or the acid test ratio. You can also deal with, or you can also use the gearing ratios to look at the capital structure of the company. How is the company being what? Or how is the long-term finances of the company are being what? Structured? Is it more of debt than equity or more of equity than debt? If it is more of equity than debt, what is the implication? If it is more of equity than debt, what is also the implication? So you look at the current ratio under the liquidity, then you also look at the quick ratio under the liquidity. If you come to gearing ratio, you look at the capital gearing ratio. You look at the debt to equity ratio. Then you also look at what we call the interest cover. So you can do these ratios if you like. You can also look at some of the efficiency ratios, which is the receivables period, which is the receivables collection period, payables payment period, inventory turnover period, and other ratios. Okay, so okay, so that is it. They will ask you directly that you should analyze the financial performance and the financial position of the company. You should know how to go about that particular issue. The financial performance will do with profitability. So you calculate profitability ratios. Financial position has to do with how the company is being structured. Are they liquid? Do they have cash? What is their position? In terms of finances, what is their position? So the first important ratio is the liquidity ratios. You calculate them. You also calculate the gearing ratios, and you also calculate some of the efficiency ratios or the working capital management ratios. The inventory turnover period, the receivables collection period, and also the payables payment period. Then you now use what you have gotten or what you have calculated to now do your interpretation one by one. That is all about it. Let's pick a question. Then we know how to write a report and know. Okay, let me talk about report writing first. You see, you cannot calculate ratios without what? Telling what? Board of directors about your findings. You have to be able to explain your findings to them. That is a report. So the question will ask you to write a report. The report always take a format. The report will always take a format. Okay. The first one is you ask yourself, who are you writing to? Which will always be the board of directors or your maybe chief finance officer or anything. Who is writing from who? You can call yourself the financial analyst or the financial controller. You don't have to, or the finance officer. Okay. What date are you writing this? You can always choose the reporting date. So maybe 31 December. So you can pick any date at all. 2023. Okay. What is the subject? The subject is just like the topic. What is the subject matter of the report? What are you writing the report on? You can say analysis analysis of the financial statement of this company. That is all. Then after this one, you come with the introduction. So you now introduce what you are doing. Introduction, what do you start? As communicated, I hereby what present to you the analysis of the financial statement of this company for your consideration or for your examination. You can also go ahead that this report has taken into consideration the information provided and other information gathered from the industry in which the company operates. The report or these are the following ratios used in analysis. You can mention the ratios, liquidity ratios, profitability ratios, working capital management ratios. That is all. Just introduction. Just in introduction. As discussed or as communicated earlier, I hereby present to you the report on the analysis of the financial performance and financial position of Kofi Limited. This report considers among many things the information provided in the financial statement and other relevant information pertaining to the industry in which the company operates in. Very simple. Then you now come to the body of the report. The body of the report, you can decide to itemize it one by one. You can look at financial performance. So you can write financial performance. So the financial performance, you'll be talking about what you have seen. So is the company doing well? They can give you maybe yearly analysis, yearly comparison. They will give you 2 years of the same company. So what is the ratio for the first year? What is the ratio for the second year now? What is the profitability position of the company? Are they doing well? So you can start by saying that, okay, the performance of the company for this year has been much better than the last year. As indicated by, then you start with the ratios that you have calculated. The gross profit margin of the company for this year is 25%. This has seen an increase of 5% over the previous year's gross profit margin. This means that the company has done well this year, which is fine, or they have done well this year more than the last year. Then you will talk about what is causing the increase over there. You can say that, okay, for this particular year, the company is able to maintain 25% of every 1 cedi sales that they are making. But last year, they were able to retain 20% of or 20 pesos of this. Just comparison, that is all. Just comparison. If you calculate your ratios, look at it. Who is doing better? First, come with the general conclusion that this person is doing better than this. Why are you saying that? Because this person's ratio is better than this person's ratio. If this ratio is better than this, what is the implication of that, or what does it indicate? If A Limited has a percentage, the gross profit margin of 25%, and B Limited has 30%. Okay. Then you look at other profitability ratios. In terms of gross profit margin, B Limited is doing better. What does it mean? It means that for every 1 cedi sale, B Limited is maintaining 30 pesos, compared to this person who is maintaining 25 pesos. So it means that these people are able to control their direct costs more than these people. So for every 1 cedi sale, they are making 30 pesos return on it. And these people, for every 1 cedi sale, they are retaining 25 pesos of it. This is before indirect cost. This is before indirect cost. The 30 pesos against the 25 pesos. Although the two of them are not doing better, how can you sell your direct cost will take 70 pesos of your what? Your revenue. What happens to the indirect cost? What happens to the fixed cost? Although the two of them are not doing well, but on the face of it, the one having a 30% is doing better. Because we're in the example, we don't have enough information to know whether this person is doing better or not. So you just say this person is doing better than this person because their gross profit margin is 30% compared to 25%. That is 5% higher than what? That of this one. This means that for every 1 cedi sale that B is making, B is retaining what? 30 pesos of it and spending 70%, 70 pesos on their direct cost. Whilst A, for every 1 cedi sale, they are retaining only 25% of it, which is equivalent to 25 pesos. And they are spending what? 75 pesos on their direct what cost. A is not effective in controlling their direct cost as compared to B. That is all. You go. You don't have to do anything. So you saying that this person is doing better than this, what is the indication that they are? Bring your figures in. It is the figures, it is based on the figures that you are saying Kofi is doing better than Ama. Bring the figures to now support your what? Your claim. That is all. That is all about the report writing. So you talk about the body of the letter. Then you now talk about what? The conclusion and recommendation. So the conclusion is what? All the things that you have said. You can just say, in short, in terms of financial performance, B is doing better than what? Than A. But in terms of financial position, A is doing better than B. Then you now look at what are some of the important ratios that each of the companies have to what? Or the company have to improve on. If their interest cover is very low, you can now ask them that, okay, they should talk to the debt holders that they should change part of their debt to equity. The interest cover is low because the company is paying more of what? Interest. They are using more of their profit to pay interest. So what should they do to reduce their interest payments? They have to change their debt to what? Equity share. If you change debt to equity share, you see that you will now be having dividends, and the dividends will not be charged, or the dividends will not be subtracted from the profit. So you just look at the important ratios that need to be improved on. Then you recommend what they should do. If the current ratio is very low, you ask them that, okay, they can talk to the payables, the short-term creditors, that they should convert some of their short-term loans to what? Long-term loans. If you are changing it to long-term loans, it will now be sent to what? Long-term liability or non-current liability. And that is not going to be having effect on the what? On the current liability or the current ratio again. Okay, let's pick a question. Then we look at how we go about this particular issue. So someone should read this question for us so that we move on.
Question 1. The most recently published income statements of Big Limited and Large Limited are presented below, together with extracts from their statements of financial position. And then we have the income statement, extract from statements of financial position. I should read the items one by one. Can you please?
Okay, so you just leave those items, then we now look at what they are asking us to do.
So the requirements: prepare vertical common size income statement for Big Limited and Large Limited in a columnar form. 2, for each of the companies, Big Limited and Large Limited, calculate the following ratios: current ratio, quick ratio, return on capital employed, interest cover, debt to equity ratio. 3, based on the results from I and II above, Compare the performance of Big Limited and Large Limited on the following measures: profitability, liquidity, and gearing. Outline any 5 limitations of ratios analysis.
Okay. So the common size, how do we go about it? For profit or loss, what will be our base?
Revenue.
Okay. So the common size, you don't have to, you can even calculate it on your answer booklet and on your answer paper and just present it like that. So you come over here, you don't have to show plenty workings for that. Okay. So you just come to Big Limited. You come to Big Limited. Then you come to the Small Limited. Okay. So this will be in percentages. Okay. This will be in percentages. So you have your revenue. Your revenue will always be 100%. So you have revenue. The revenue will be 100%. Revenue will be 100. Okay, the percentage is already at the top. So you have 100, 100. Okay, let's count to cost of sales. Okay, what will be the percentage for big? How do we get a cost of sales?
For big, cost of sales now is 7,296 divided by 11,600.
Okay, what's the percentage?
I'm getting 62.89.
Okay,
62.9.
Okay, 62.9. Then you just go and put a 62.9 here. Okay, what will be for the Small Limited? Jocelyn, your hand is up.
Yes, please. Sir, so this is common size for
Vertical.
profit or loss.
Yeah,
So vertical.
Okay.
So that means for each line item, the base will be revenue.
Yes, please.
Oh, okay, thank you. So we have vertical and horizontal.
Yes, please.
Okay. But for the horizontal for this one, what would be the difference, please?
Horizontal, they have to give you more than a year. So you just find the change, the growth in each of the items one by one.
Thank you very much.
So I hope we have gotten the idea for the vertical now, isn't it?
Yes.
Okay.
Yes, please.
Can we move on to statement of financial position horizontal? The common size. So this is profit or loss. So you can count to statement of financial position. With the financial position, the base will be what?
Total asset.
Okay. Can we get a total asset from here? Are we giving a total asset?
Let me see. Total.
Yes.
No, we don't have total asset.
We don't have.
So you have to find your total
You have to
asset
find,
now.
yes.
Okay. How do we get it?
And so it will be 430.
430.
4,210.
How did you get that?
$2,900.
2990.
Total asset.
4,000 for Big Limited. The total asset, it's Big Limited.
I had 2990.
Yes, Big Limited is 2,990.
Are you sure?
No,
because
please, it's 6,450 for Big Limited.
Linus,
So
are
you
we using Net asset or
Net
total
asset
asset?
or
We are
total
using,
asset?
we are using total assets.
Total
And so we
asset.
have the current assets and then the inventory. That is what we added.
No, total assets, we should have current assets and
990.
non-current assets. You are not giving non-current assets, so you can't find a total asset from the asset perspective.
Because we're only giving current assets.
Yes, please. So you should have non-current assets. But you can find a total asset from the perspective of what? Equity. You know, the total asset is equal to the equity plus the liabilities.
Yes.
And so just add 7,038.50 plus the current liabilities of 1240.
Can you come again, please?
Okay, the total asset will be 7,000. Will be the 7,000 plus non-current liabilities of 38.50 plus what? 1240. Because total asset is equal to what? Total equity plus total liabilities. Is that not the case?
Okay.
Okay.
So in that case, if you are not giving non-current assets, you cannot use the assets.
You cannot use the assets
So-
perspective.
Okay.
So you have to use the equity and liability perspective.
Yes, please. Because the total
Oh,
asset must be
okay.
equal to the total equity plus liability.
Oh, okay.
Okay. I hope you're okay.
Thank you.
Okay.
Yeah.
Yes, please.
Okay. So let's look at the equity portion of it.
So the total asset will be 12090.
1, 2.
12090.
Okay. So
For
we can
big
now,
limited.
so we can now do big and small. Okay. So let's come to total equity. What will be the percentage?
57.9.
60.
57.9.
Okay. Can we make it 58?
Okay.
Okay. So the second one too. Then you do the same thing for them. You do it for all of them one by one, using the total asset as the
base.
As a base.
Please, where did you get a percentage from?
The percentage for big, we use 7,000 divided by 12,090 times 100.
Oh, okay.
Okay. So I hope we have also gotten the basic the calculation for that one to how to go about the remaining one, isn't it?
Yep.
Yes, sir.
So we can now look at the ratio itself. Okay, so let's look at the ratios one by one. Which one are they asking us to calculate first?
Current ratio.
Unless you like multiplies 2 years, the issues are great.
Okay, so the first one is current ratio, isn't it?
Yes.
Let me show you how you can do the ratio. The ratio, do it in tabular form. Okay, so you put the ratios here. You put the formula here. Then you put the companies here, big limited and small limited. Okay, so you just put the ratios here. Like you put this one here, you put this one here, then you come here. So what is the first one that we are calculating? Current ratio. Okay, so the current ratio, how is current ratio calculated?
Current assets over current liability.
Okay, current assets over current liabilities. All is to 1, isn't it? Okay.
Yes.
So what is the current asset for big and what is their current liabilities?
$26,600.
Big 2,600.
Okay.
And it's more than that.
2,600
Over
divided by
1240.
Okay. What of small limited?
Small limited is 2,200 over 1680.
2,200.
1680.
Okay. 1680. What's the figure that we are going to be getting?
For small limited, you are going to get 1.31 is to 1.
1.31
Is to 1.
to 1. Okay. Big limited will be what?
2.10 is to 1.
2.10 is to 1. Okay.
Yes, not 0.1. 1.0.
Okay, 1.0. Okay, let's go to the next one.
Quick ratio.
Okay, the next one is what? Quick ratio. How is the quick ratio calculated?
Current asset minus inventory over current liabilities.
So current assets minus the closing inventory over current what? Liabilities. Okay, all is to 1. So let's find their quick assets.
Big 2,600 minus of 390.
Okay, so you can just write the full amount. You can just write the net amount there.
So 2,600. That would be 2210.
2210. Okay. Divided by 1240.
Yeah. And that will give you 1.78.
1.78 is to 1.
Small limited will be 1980
1980
divided by 1680 is to 1.
Okay. All is to 1.
Yeah. 1.17 or 1.18 is to 1.
1.18.
1.8.
1.8.
Okay, is to 1.
Which the president was 1,500. I don't know if maybe the supplementary. I don't have the president. So the 1,500 is the supplementary budget or everybody's budget.
Okay.
You don't consider the actual budget. Yeah, this is the original budget.
Okay. The next one is what?
Supplementary budget here.
Return on capital employed.
Return on what?
Capital
Capital
employed.
employed.
So how do you calculate that?
Profit before interest and tax over capital employed.
Can you also add that
Okay. So is net profit before what?
Interest and tax.
Over the net assets
Net assets.
or the capital employed times 100. Okay. So can we get
you see that I want to know when you check the exam papers, most of the exam papers are very small, and we have the original budget there, of which we will not use, right?
okay? So from the question, can we be able to determine the net profit before interest and tax?
Yes,
You
please.
can ask
Okay.
operating profit.
Okay, that is the operating profit, isn't it?
Operating profit. Yes.
Big is what? 2466.
66.
Okay. What will be the value of their net assets? The net asset is the shareholders fund plus the what? Long-term loan or non-current liabilities. So it will be these two. Okay.
10,850.
Okay. So that will be 10,850 multiplied by 100. Let's go to small limited.
It's 172 divided by
1722
6522
divided by
6500.
6500. Okay. Multiplied by 100.
26.19%.
26.49.
49.
Okay.
22.73.
22.7. Okay. The next ratio is what?
Interest cover.
Interest cover. How do we calculate the interest cover?
Is the finance cost. Finance cost.
Okay. A is what?
No. Net profit before interest and tax over interest charges.
Okay. Profit before interest and tax over what?
Interest charges.
Okay. So net profit before interest and tax over the finance cost. What does it measure?
Measure the interest payment.
Number of times.
The number of times our net profit can cater for the finance cost anytime it falls due.
Okay. What you have to have in mind that profit is not cash, isn't it? Okay. But the assumption is that if you want to use our profit to settle our interest, how many times can our profit settle our interest? So what happens is that if the ratio is higher, is it good for the company?
No, please.
Why?
Yes.
Okay. Let the argument begin.
It's good for the company.
If it is higher, it is good for the company. Okay.
Yes.
Someone also said no. So let the argument begin. The no will go first or the yes will go first? We want to know how people you want to start the argument.
The yes means the number, like if the number of times is small, meaning that's the number of times that our net profit before interest and tax can cater for our finance cost.
Okay. So it means that even if we cater for we are able to cater for the finance cost, we still have a large portion of profit to distribute among our owners. Okay. So if the number of times is 7, okay, the meaning is that if we settle our finance cost this year, we will still have 6 times of what? That finance cost. Because 7 times our finance cost is the profit. So if we settle one, it means that 6 times of the finance cost will still be available as a profit, which we can use to what? To pay dividends and take other issues into consideration. But if it is 3 times and you pay finance cost, it means that 2 times of the finance cost will be available. And you want to what? Retain some of the profits. And you want to pay dividend. You cannot be able to pay dividend because the portion of the finance cost left, it is not that high for you to declare dividend out of it. So if it is higher, it means that the company is what? Is in a better position to borrow, maybe like to the extent that they want, but that is not the issue. But if it is high, it means that the company is doing well. The company is doing well, and that is better for the company. They can still declare dividends and still have some portion of the profit to retain. That is it. So if it is low, it will come to a time that the company cannot use, maybe if the company is not doing well, it means that their profit cannot be able to settle their finance costs, and that will be a problem to them. So low means it's not good, but high means it is good for the company. So senior, for the no, I hope you're okay.
Yes, please.
Okay. Okay. If it is low, it is likely that if care is not taken, the company will now be facing a gearing what problem. Okay. And if it is low too, it might be that the company is highly geared. They are having more of debt than equity. And as a result, they are paying more interest. They are paying more interest. So you have to pay attention to those issues. Okay, we know the profit already, isn't it? We know the profit to be 42466 1722. So we can divide by the finance cost for each of the companies.
5784 big.
Okay, 578.
And then 180 for small.
Okay, so what will be their interest cover?
4.27.
4.27.
And then 9.57.
9.57. Okay. What is the
debt to equity ratio?
Okay. Debt to equity ratio. And that is calculated as what?
Debt over equity fund.
Okay.
Times 100.
So we have debt over equity times 100. So the debt over here will always be long-term what? Debt. Or the question can say interest-bearing debt. Okay, if they say interest-bearing debt, then you also include what? Bank overdraft. But if they say debt, and you count the non-current liability and you have deferred tax, don't include the deferred tax as part of what? As part of the long-term. We use only the interest-bearing what? Long-term instruments. So if you have debentures over there, if you have maybe preference shares over there, you can include them. But the deferred tax is not an amount that you are going to be paying, and it's also not something that is going to be attracting interest. So we exclude that particular one and calculate our figures. Okay, let's go to the figures. What is our debt over there? The debt, we assume that is purely the what? The long-term what? Okay.
So 3850
3850.
for big.
Okay.
1,500 for small.
Okay. Multiply by 100.
So
Okay. The equity is 7,000 for those one. Okay. 1,500. What is the equity value for?
55%.
This one is
5,000.
Okay, this is 5,000.
5,000. Yes.
Okay, this will be 5. The equity that we use is not the share capital, it's the shareholders fund. So you add the share capital, you add your retained earnings, you add your reserves. That will form the equity. Are we okay? Not the share capital, no. It is the total shareholders fund that forms the equity. Okay.
Okay.
So
But
what?
with this one, it's only okay. That's a total equity 7,000.
Okay.
So we have 55% for big.
And small is what?
Small is 30%.
30%. What is the next ratio?
The next ratio, I think that is
That
oh.
Okay. So what is the first thing? They say you should compare the what?
Based on the result from I and II above, compare the performance of Big Limited and Large Limited on the following measures: profitability, liquidity, gearing, and gearing.
Okay. The things that you'll be using for gearing is the debt to equity and also the interest cover. Okay. The profitability will be the ROSI for the ratio analysis. It will be the ROSI. Okay. If you look at the ROSI, who is doing better?
small.
Small is doing better than these people. So you talk about a ROSI in terms of profitability, that is the ratio analysis. But they say you should use the common size and then the ratio analysis. They didn't ask you to write a report. Don't go and put format over there. You can just put what a heading there and start your comparison. So you can just say comparison of the financial statement of big and small limited. That is all. Then you just start with your comparison because they haven't asked you for a report. Then you start with profitability what? Analysis, because that is what they have asked you to look at it. So you look at the ratio over here as the ROSI. So you use ratio, you use the ROSI as the profitability ratios, but you also go and look at your common size. Based on the common size, what is the gross profit percentage? So if we have done a gross profit percentage, we can assuming this will be 37.1. Okay, something over here, let's say this is 20 something point something. Okay, you can see that on the common size basis, the gross profit margin of the company is higher than that of what? That of small. So you can also use the gross profit over here as the basis. So you just look at all the profitability issues, you use the gross profit over here, and then the net profit also over here. Then you compare and see which of them is doing better, which of them is having higher of these ratios than the other. So if this is 37.1, let's calculate the small. Let's calculate the cost of sales for
Small is 31%.
is what?
It's 31.
Okay. Is it the cost of sales or the gross profit?
The gross profit.
Okay. That will be 31 points.
It's just 31%.
Okay. That's 1.0. Okay.
Mm.
Can someone try the net profit margin for me so that I can use it to do the analysis?
For big, net profit is 12.21%.
12.21%. Okay. Small is what?
10.92%.
10.92%. Okay.
Yeah.
You can see that it's only the ROSI. It's only the ROSI that what small is having than what than the big, isn't it? Okay. So you come to your profitability analysis. You come to profitability analysis. Even if you don't know what to say, you can just bring the ratios that you have calculated. You can say, okay, gross profit margin to revenue. So gross profit to revenue. Or you can say, okay, the common size. So you can talk about a common size issue. Then you say gross profit margin or gross profit to revenue. Okay. Then gross profit to revenue. You can say the gross profit to revenue. What you say that from the gross profit to revenue, big is having what? 37% of the revenue of big represent their gross profit. That means that for every 1 cedi sale that they are making, big is returning what? 37 pesos, and small is returning what? 31 pesos. It means that big is doing better than what? Small. So you can talk about gross profit margin. Then you count to the net profit also. For the net profit to revenue, big is having 12.1%, small is having what? 10.92%. It means that for every 1 cedi sale, big is returning what? Big is returning 12.21 pesos, while small is returning what? 10.92 pesos. This is before any dividend will be paid. This also shows that Big Limited is able to manage its direct and indirect costs better than what? Than the small limited. You can also talk about certain things that is going to cause this particular increase over here. You can quickly calculate the net asset turnover and see whether Big is utilizing their asset more than what? The other company, which is the small limited. So if you don't know what to say, you can just quote the figures that you have calculated and say what is the meaning, or what the figures actually represent. Then you count to the ROSI. If you count to the ROSI, you can also talk about the ROSI. Okay, so you talk about, okay, in terms of return on capital employed, ROSI has a higher return on capital employed than what? Small has a higher return on capital employed than what? Than big. As indicated by 26% against 22%. This shows that for every 1 cedi investment that the people are making in big is giving them 26 pesos, while small is giving them 26 pesos, while big is giving them only 22 pesos. That is all. You can go about that one, or you can also talk about how big can be able to improve that, or why the return on capital employed is low, is small for big and higher for for small. It can also be the investment in their capital. Big might be doing more investment in their capital, and they will be underutilizing their assets. So you can also talk about what is causing the small having a higher return on capital than big. It can also be as a result of the utilization of the net assets. So you can also look at the net asset turnover. You can also look at the company having a higher cost of sales than the revenue. You can also talk about those issues. If you talk about the liquidity ratios, the liquidity ratios, you'll be using the current ratio and then your quick ratio. You can see that from all indication, big is doing better, or big is having a better financial position than than small. So you talk about this one, quote their ratios, then you move on. And why this particular ratio, or what is the implication of this ratio? The current ratio being 2.1 means that the big limited can use their current asset to pay their liabilities 2 times. That is the meaning. Whilst these people can pay only 1 point something times. It means that these people, they are having a higher position in terms of liquidity, or they are having enough cash as compared to this one, or they can be able to settle their short-term obligation assets when they fall due in a higher proportion than what the other company. So you fall on these ones and now draw your conclusion. If you come to your gearing, the gearing will be looking at the interest cover and the debt to equity ratio, and also maybe the common size calculation that you have done. That is what we are going to do. Just use your ratios to say this person is having this person is having this. Why? Or what is the meaning of this person having this? It means that this person is doing this person is doing that. That is all. You just move up. That's all. Let me tackle the. So after calculating the ratio, if you say this person is having 20%, this person is doing better, what is the proof? The ratio will give us the proof. The ratio will give us the proof. Seniors, my battery is down, and I would like to take the question 2 of this one. But what will happen is that I will explain the question 2 tomorrow when we are doing, we'll do standards tomorrow and then the final accounts. So if we are going to start, I will explain the question 2. But for now, my battery is less than 50%. It's less than 15%. Please, any question?
Okay. Thank you so much for your time.
Okay, so now.
You are really doing well for us.
Okay. Thank you, senior.
So please, is it same time tomorrow?
You said?
Is it same time tomorrow?
Exactly.
So we go to church. Are we not going to church?
Okay, so let's make it, I don't have class in the evening, so let's make it maybe 1 p.m. to 6 p.m. or 7.
Okay.
How that is
Okay.
okay.
Yes, please.
1 to 6 p.m. Okay.
Yeah, someone is saying that me, I don't like church, so I don't want it to happen like that. So I'll see you guys tomorrow.
All right. God bless you.
Okay, thank you, sir.
Have a nice day.
Thank you, sir.